You all know that Income Tax Act 1961 is divided into different heads. There is salary head, house property, PGBP, capital gains, and income from other sources. And PGBP is the most difficult and the lengthiest portion of Income Tax Act. Here we are trying to cover the whole portion of PGBP in one video as a marathon course. This is beneficial for CA, CMA, CS courses, and it can be used by businessmen and professionals as well.
Now, let us first see what's the business and what's the profession. Any trade, commerce or manufacture, or any adventure or concern in the nature of trade, commerce or manufacture is a business. Generally, business means recurring economic activity, but for income tax purpose, an isolated activity may also be considered as a business. Any business activity which is economic in nature with the objective of earning profit is a business. We call some activity an adventure when we are doing it for the first time without knowing its outcome. Section 213 of Income Tax Act defines the business. But profession is not defined in the Income Tax Act. Section 236 says profession includes vocation as well. Now, when we say profession, even though profession includes vocation, profession requires purely intellectual skill or manual skill on the basis of some special learning and qualification gathered through past training or experience. Example, a chartered accountant, doctor, lawyer, etc. Professional skill can be acquired only after systematic study, maybe in a college or an institute, and we can apply the knowledge acquired in the practical applications. Vocation is the natural ability of a person to do some particular work, maybe singing, dancing, etc. The term vocation is different from the term hobby. Vocation must have the earning feature. So, unlike profession, vocation does not require a degree or special learning. Now let us see what is meant by profit. Profit can be in cash or in kind. When we say in kind means it is not in cash. Profit is realized in any form other than cash. Then cash equivalent of the same on the date of receipt must be taken as the value of the income received in the kind. If you receive a mobile phone as kind, then the equivalent fair market value shall be accorded as income. Capital receipts. PGBP head deals with the revenue receipts only, and capital receipts are dealt separately in the capital gain head. When you consider the profit and loss account, we have the income part and we have the expenses part. In the expenses, all allowable expenses under income tax are considered. Then from income and expenses, we can derive the profit. Voluntary receipts. Voluntary payment received in the course of business or profession shall be treated as income in the hands of the recipient. For some voluntary receipt to be considered as income, there should be a clear nexus or connection between the business and the payment received. For example, a lawyer receives some gift, additional gift, other than the professional fee received by him from the client, say for winning a difficult case. So the fair market value of that gift is also to be added to his professional income, business income. Application of the gain, profit or business profession is immaterial. So you may get a business income, but for what purpose you are using that profit or that income is immaterial. You may use it for some philanthropy purpose, maybe for some good cause or for the benefit of the community. So whatever be the application of the income you receive, if you earn income from business or profession, you are liable to pay tax for that. Legality of the income. So it is immaterial whether you earn the profit from legal or illegal business. However, such unlawful incomes are not allowed for deduction while computing profits of such businesses. Income from distinct businesses. An associate might have multiple businesses. He may have cosmetic businesses, then he may have textile businesses or fast-moving consumer goods businesses. Even though the profits are calculated separately, the tax should be calculated on aggregate profit. Computation of profits. Profit should be computed after deducting the losses and expenses incurred for earning income in the regular course of business, profession or vocation, unless the loss or expense is expressly or by necessary implication disallowed by the Act. That means all allowable expenses can be deducted from the income to arrive the profit. The tax levied not on the gross receipt but on the profit and gains. For the purpose of income tax, whether you are having a business or profession or vocation, profit from all the sources are treated on similar grounds. Now, for any head, the most important or the first section we are considering is the chargeability section. Income chargeable under the head PGBP is detailed under section 28 and part of section 41. So, under section 28, clause 1 to 7 gives the various incomes to be charged under income tax. So section 28(1) says profit and gains from any business or profession carried at any time during the relevant previous year is chargeable under PGBP. So if you are having some income from residential properties, that will be charged under house property and not under PGBP. Even though you are having the business of letting out houses, that income is chargeable under HP, house property, and not under PGBP. When we say income from business profession, we have to consider income from speculative transactions also. The speculative transactions we will discuss in detail in the next sections. Section 28(2). Any compensation or the payment due or to be received by any person managing the affairs of an Indian company or by any person managing the affairs of any company in India when it is terminated or modified the terms and conditions of the agency's appointment, then if they receive some compensation out of this, that income is chargeable under PGBP. Any compensation received by a person holding an agency in connection with the termination of the agency or the modification of any terms and conditions relating thereto is chargeable under PGBP. Similarly, any compensation received or receivable in connection with the modification of terms and conditions of a contract is also chargeable under this head. For example, ABC Limited gives some contract to a supplier for raw material for 1 crore, and as per the contract conditions, actually, if they are not supplying or if they're delaying the supply by 1 month, there will be compensation of 0.5%. If they delayed by 2 months, there will be compensation of 1%, that is 1 lakh, if the supply is for 1 crore. But unless otherwise there is a modification in the contract, then it is not chargeable under PGBP. And if they are getting a compensation after modification of the contract, then only it is chargeable under PGBP. Section 28(3), income from specific services performed to its members by a trade, profession or business association. Here there are different associations, trade associations are there. But actually, if the membership fee is collected from the members and it is used for their own purpose, it is not an income and it is not chargeable under PGBP. For example, a housing society. There are different members in the housing society, and from the members they are collecting a fee for the common facilities, and in 1 month they collected 50,000 rupees and used 35,000 only, and 15,000 balance is left. That amount 15,000 is not a profit. Okay. It is based on the principle of mutuality and it is not taxable. It is not considered as a deficit or profit, a loss or profit. But you consider a market survey conducted by FICCI, the Federation of Indian Chamber of Commerce and Industry. If they give some market survey, some service of market survey for one of his members for an amount of 60 lakhs, when they deduct their expenses of 45 lakhs, for example, then if they get a profit of 15 lakhs, that is chargeable under PGBP. That is for specific services for a specific member. It is not a common cause of all the members, not for the common cause of all members. Now, section 28(3)(a), 3(b), 3(c). An export incentive in the form of import entitlement license, duty drawback, duty-free replenishment certificate, all are taxable if they get an income out of this. Import entitlement license is a permission to import some restricted items to a certain percentage of the export. And this certificate is, this license is transferable. No money is credited here. You will get a certificate to this effect. And the sale proceeds of this import entitlement license is 100% taxable under PGBP. There is a duty drawback or DEPB, duty entitlement passbook is there. So that duty drawback scheme aims to provide the refund or recoupment of customs and excise duties paid on inputs or raw material and service tax paid on the input services used to manufacture export goods. When you are exporting some goods, you may be using some raw material for the manufacture of the exported goods. And whatever duty you paid, excise or customs duties, they will be refunded, recouped to their bank account or to duty entitlement account, DEPB, duty entitlement passbook. It's a separate account, there it will be transferred. So, different rates for duty drawbacks are there for each industry. These are fixed by the government after every budget through all industry rates. For example, for car manufacturing industry, the rate is 20%. The profit on transfer of duty entitlement passbook is actually the difference between the sale proceeds and the amount available in the DEPB account. Okay, so the difference amount is taxable under PGBP. Then there is a duty-free replenishment certificate. So in duty-free replenishment certificate, actually, there is, if you are using some imported goods for the manufacturing of exported goods, then for some certain percentage of the export, you will get, you can import the input that used for manufacturing the export product duty free. So maybe 10% is the rate of duty free replenishment certificate, and you are exporting 1 crore up to 10 lakh, you can import items duty free for the manufacture of the exported items. Export incentives received or receivable or to exporters is PGBP income. These are all called EXIM script. This is mainly the government is giving such kind of incentives to encourage the export. Under this EXIM script, exporters can get import duty concessions to a fixed percentage of their export value, which is transferable. Now, the foreign trade policy is formulated every 5 years, and now the latest FGP is from 23 to 28, 2023 to 28. Now, cash assistance received or receivable by an exporter under the Government of India scheme is also chargeable under PGBP. Now the duty drawbacks rates are either a percentage of the free on board value of the exported goods or represent the rate on a per unit basis. Thus, if your FOB value is 10 lakhs and your drawback is 10%, you will have 1 lakh payable. FOB stands for free on board. It is an international shipping term used to specify when the seller's responsibility for goods ends and the buyer takes out. The seller is responsible for all costs up to the named port of shipment. The buyer is responsible for all costs after the good passed the ship's rail at the named port of shipment. So the seller is responsible only up to the shipment point. Once it is shipped, it is the responsibility of the buyer. So duty drawback can be received in the bank account or in the duty entitlement passbook. Both ways it is taxable under PGBP. So the export incentives available to exporters are profit on sale of import entitlement license. The whole sale proceeds is taxable. Cash assistance received by a person against exports, then duty drawbacks, 100% taxable when credited to bank account or DAP. Profit on transfer duty entitlement passbook scheme is the difference between sale proceeds and the amount available at the DAPV. See that the profit on transfer duty free replenishment certificate is 100% sale value is taxable under PGBP. The duty free replenishment certificate is issued to an exporter or manufacturer for the duty free import of inputs such as raw materials, component, intermediates, consumables, spare parts, etc. to be used for the export or production. Now section 28.4. It says value of any benefit perquisite from business or from excess of profession in cash or in kind fully or partly taxable under PGBP. For example, there is a TV dealer and his target given is 10 lakhs per month. And if he achieves this target, he will get a free trip to Switzerland for 2 lakhs. Now, the worth of the trip, 2 lakhs, is chargeable under PGBP as far as the TV dealer is concerned. In the hands of the dealer, this amount is taxable. Section 28.5. Sum or remuneration due to or received by a partner of a firm. Now, In a partnership firm, any remuneration received by the partner except LLP are taxable under PGBP in the hands of the partner to the extent allowed in the hands of the firm under Section 40B. That means 40B, Section 40B limits the amount that can be transferred to the partners that as remuneration, interest, commission, bonus, etc. The maximum interest that can be paid to a partner for his investment is only 12%. And if more interest is paid, whatever percentage given above, for example, if 15% is paid, the 3% is taxable for the firm. The partner is responsible for only 12%, and for him it's the PGBP income. For the partner, 12% if you are getting, he is responsible for 12% under PGBP. That is considered as a income, and he has to pay tax for that. But the share what is getting, profit share what is getting is not taxable, because the profit share is given from the taxable profit of the company. Already company is paying tax for the profit. 40B, there's a maximum permissible limit for remuneration. So if you have income up to 1.5 lakhs, you can pay maximum 1.5 lakh to the partners. Between 1.5 to 3 lakhs, 90% of the book profit can be given up to 3 lakhs. And above 3 lakhs, only 60% can be given to the partners. And the maximum percentage of interest is only 12%. 40B limit the salary and interest to partners, thereby removing the possibility of sharing the whole income of the firm to partners. They will not paying any tax by the firm. For example, if you have 21 lakhs profit, there are 3 partners, it can be equally divided between the 3 partners, 7 lakh each. That means actually there is no tax for the firm. So this is prevented by limiting the remuneration that can be paid to the partners. They can give actually 7 lakhs as salary to the 3 partners, and 7 lakhs mean 21 lakhs is completed, and there is no tax for the firm since it is given as salary. Because up to 7 lakh is not taxable for this financial year. As per Section 10(2)(a), a partnership share the total income of the firm is exempted from tax. The partner share is divided in the profit sharing ratio based upon the investment of the partner. Section 40B we will study in detail in the later sessions. So I am not going to elaborate it here actually, because then it will be repetition when we learn it in the other sessions. As I mentioned, the book profits, if you are saying if the book profit is negative loss or maybe up to 1.5 lakhs, maximum amount deductible in respect of remuneration to partners under Section 40B is 1.5 lakhs. And if it is up to the first 3 lakhs, that means between 1.5 to 3 lakhs, 90% of the book profit, whichever is higher, can be given. On the balance, 60% of the book profit can be given. I mean, if it is 10 lakhs up to 3 lakhs, you can give 90%, and the balance 7 lakhs, 60% can be given to the partners. So any remuneration above this limit is not allowed as deduction in the hands of the firm, and also not taxable in the hands of the partner. There we can see the salary, commission, etc. are PGBP income for the partner, and the share on profit is exempted. Interest on capital is the PGBP income for the partner. Section 28(5)(a), non-compete fee. Any sum received or receivable in cash or in kind or an agreement. Now this non-compete fee is given for not carrying out an activity in relation to a business or profession, or it can be for not sharing any know-how, patent, corporate, trademark, license, franchise, or any other business or commercial rights, information, technique likely to assist in the manufacturing, processing of goods or provisions for services. There are of course exceptions. And if you receive some amount in cash or kind for transfer of right to manufacture or produce, you are getting it for transferring. The other one is non-compete fee is getting for not transferring. For transferring you are getting some amount, then it is under capital gains, chargeable under capital gains. Any compensation received on the Montreal Protocol on substances that deplete the ozone layer is not chargeable under PGBP. That means actually maybe the under Montreal Protocol, maybe some, for example, in the refrigeration industry, the freon gases are not to be used. That is restricted. For that, actually, if you are getting some compensation, then that compensation is not PGBP income. Now, section 28(6), key man insurance policy. In any industry, there will be some key persons, and these key persons are running the business, and if they leave the business will be in big trouble. So the employer can take key man insurance policy on these employees. Okay, any sum received under key man insurance policy as an employer, including bonus, is taxable under PGBP. As per section 10(10)(d), key man insurance policy is a life insurance policy taken by a person on another who is or who was an employee of the first mentioned person or the employer in some manner connected with the business of the first mentioned person. The key man insurance policy, if the bonus received by the employer, it's PGBP income, and if it is received by the employee, it is considered under salary head, and if on the demise of the employee, if it is given to the legal heirs, it is income from other sources. A key man in a company refers to any employee who is considered crucial to the smooth operation of the business, meaning their absence or disability could significantly impact the company's profitability or functionality due to their unique skills, expertise, or critical role in key operations. Essentially, they are considered indispensable to the company's success. That means these persons are very much important to the company, and their and actually their involvement is very crucial to the success of the business. That's why they are insured. Section 28(6)(a), conversion of stock or inventory into capital asset, conversion and the treatment of that. So when it is converted, the fair market value to be taken as business income or at the date of conversion to capital asset, and it is chargeable under PGBP income. For example, an AC and air conditioner seller, and AC is an inventory for him, and if he take two of that air conditioner for his office from the inventory, then that will be converted into PGBP income, because there is a difference in opening stock and closing stock of inventory, and that will be reflected in the as loss in the P&L. This will be compensated by treating those inventories converted to assets as income in P&L account, so that the impact on profit will be nil. Now, you can consider another case, maybe some builder. Builder is actually taking one of the houses as his office. Then also it is the similar case, because as far as the builder is concerned, the houses are his inventory. When he is taking for his own use, that will be converted into capital asset and is chargeable under PGBP. Section 28(7). This says that if you receive some amount on account of the capital assets being transferred, demolished, destroyed, which are already deducted from the income, means the 100% deduction is received under 35(a)(d) specified businesses, and if you get some income out of transferring of such assets for which 100% deduction is claimed, for those sum tax is to be paid under PGBP. In normal businesses, only depreciation on capital assets is deductible under profit and loss account. But for specific businesses, under 35(a)(d), 100% deduction is given. We will learn in detail what is specified businesses. Specified businesses are some businesses the government wanted to promote. For that they are giving, to promote such businesses, they are giving maintained 100% reductions. For example, a gas pipeline. It's a very huge capital intensive business. So actually nobody will come forward for that. And for that, so since it is a gas pipeline is very much required, government is giving a 100% reduction for the capital investment as well as the revenue investment, both. Giving. So already the reduction is claimed. Then if you are selling those assets for which already reduction claimed, and if you are getting some amount out of that, that amount is chargeable under PGBP. Then there is an explanation too of the chargeable section 28, that is explanation is regarding speculative business. income from speculative business. Now income from speculation business is charged under PGBP, but that business must be deemed as distinct and separate from other businesses. Speculative transaction is a transaction in which a contract for the purchase of sale of any commodity, including stocks and shares, is settled otherwise than by actual delivery of or transfer of the commodity or goods. So there are two types of transaction. There is intraday transaction and intraday transaction in stock exchanges. So when there is intraday transactions, the shares are not actually sold or purchased. So because we are using demat account for such transactions, at the end of the day, that means from the transactions are carried out from 9:15 a.m. to 3:30 p.m. Okay, 3:30 p.m. And at the end of the day, that is 3:30, after 3:30 p.m. only, that net shares are calculated, and if there is no change in that, actually it will not be considered as a sale. So within a day, there is such speculative income is created. That income will be chargeable under PGBP. If it is more than one day, it is intraday transaction, that will go to capital gain. Here actually only speculative transactions of shares are considered as PGBP income. It does not cover transaction in respect to trading of derivatives or commodity derivatives. Also, it does not cover transaction by a company, the principal business of which is the business of trading in shares or banking. For a company which is in the business of trading of shares, the income is PGBP income. But both cases it is PGBP income, but actually speculative transaction you have to consider separately. Why? Because actually the losses of the speculation business can be carried forward or set off by the income from gain or profit from other speculative businesses. You cannot set off with the other businesses other than speculation businesses. Therefore, speculative businesses has to be considered separately. A loss of speculative business carried forward to a subsequent year can set off fully against the profit or gains of any speculation business in the subsequent year, and hence must be treated separately. This deeming provision does not apply to a company whose gross total income is mainly from heads, interest and securities, income from house property, capital gain or income from other sources. A company mainly engaged in the business of trading in shares, banking or granting loans and advances, this is not applicable because for them it is not a speculative business, it is the main business income. If the companies carry out buying and selling of shares of other companies, it is not considered as speculative business. Exceptions: not speculative transaction, hedging contracts in respect of raw materials or merchandise for manufacturing or merchandise business to guard against price fluctuations affect this contract. The hedging of raw material or maybe metals. For example, there is a cable manufacturing company, and the cable manufacturing company, they are using copper conductor in the cables, and the copper prices is fluctuating, and because of that, to safeguard against the fluctuation of the copper, they are hedging it. Maybe for they are actually they are hedging it for 2 months. Maybe after 2 months they are fixing the price. They are saying, okay, I will buy the copper at this price after 2 months. That is hedging. So This is they have done to safeguard against the fluctuations. So at a fixed price, that price they will get it. In case there is a difference, they have to pay the difference. So such kind of hedging for safeguarding fluctuations is not considered as speculation business. Hedging contracts in respect of stock and shares to safeguard against the loss of holding of stocks and shares from price fluctuations. It is also not considered speculation business. Forward contract entered by member of forward market or stock exchange, trading in derivatives in a recognized stock exchange, trading in commodity derivatives carried out in recognized stock exchange is chargeable to commodities transaction tax under Chapter 7 of Finance Act 2013. Now for trading of commodity derivatives, there is a tax is there. There is actually commodity transaction tax. This is very small tax has to be paid. And this is actually is chargeable under PGBP. Trading of commodity derivatives, if you are getting some income after that, then you will just be charged under PGBP. Transaction of a company whose main business is trading in shares or banking, it is not considered as a speculation business. But the interest is the PGBP income. Now you can see the stock market, there's equity stock and commodity stock is there. Equity that's intraday trading is there, the spot market intraday, that is the speculation business is there. It will be charged under PGBP. Intraday, after one day it is being sold. After buying, you keep it for one day and you are selling it, then it is actually, as far as the trader is concerned, for him it is a inventory and it is a PGBP income for him. As far as investor is concerned, it is a capital gain for him. But there is actually that a future and options derivative market is there, F&O market, and it will be PGBP income for the F&O market. And if you consider the commodity market, there is agricultural commodity and non-agricultural commodities there. For example, metal derivatives, there will be PGBP income for non-agricultural market, and for agricultural market there is speculation income. Now you can see the share investment for investor, sale of a share is for getting some income out of it is a capital gain for the investor, and dividend is income from other sources. And for inventory, it will be sale will be PGBP income, and the dividend is income from other sources. And for securities and debenture bonds, investment for investor, sale is actually capital gain and interest is income from other sources. Stock and trade, sale is capital gain and interest is income from other sources. Yeah, interest is income from other sources. Now, trading in shares are done through demat accounts of NSDL or CDSL. CDSL is Central Depository Service India Limited, and NSDL is National Securities Deposit Limited. These are the subsidiary of National Stock Exchange. Okay. This help the investors, financial institutions and government agencies to buy, sell and store financial securities electronically. Now, the security transaction tax is applicable on trading of securities. Intra-day trading income without actually selling or buying is speculation income. Normally, the trading happens between 9:15 a.m. and 15:30 or 3:30 p.m. It's from Monday to Friday it's happening. The shares will be reflected in the demat account after the closing hours. In case there is a difference in shares at the end of the day, it will be reflected in the demat account. You can sell shares even when you don't have the same in your demat account and buy at a lower rate within the same day without having the demat account, thereby making speculative income. And this income is chargeable under PGBP. Now we have covered all the sections under 28, under section 28, the chargeable section, and some other sections are there, which are deemed profit, and the treatment are there under section 41, which we will consider in the next session. In this session, the profits chargeable to PGBP, the deemed profit and the treatment is discussed. The following are deemed income under PGBP. Business income in the previous year in which such benefits are obtained. Chargeable even if the business from which they arise ceased to exist prior to the year in which the liability under section 41 arises. The firm or the business organization may not be there. The business might have been ceased to exist. Even then, this section is valid. Now the 41 clause 1 refers recovery under any deduction, remission, cessation of trading liability. So you might have already got some deductions, and that those allowed deductions, maybe some cases you might have got 100% deductions. So if you got 100% deduction, for example, we can the scientific research 35D, we are getting 100% deductions, and if you are getting any income for those assets for which you have claimed 100% deduction, those income are charged under PGBP. Where an allowance reduction is allowed in any assessment year, in respect of loss, expenditure, trading liability, and in any subsequent previous year, any amount received in cash or kind in respect of such loss, etc., by way of remission or cessation thereof, the amount obtained or the value of benefit accruing shall be taxable as income of that subsequent previous year, disregarding whether the said business or profession is still in existence. So that is immaterial whether that said business is in existence or not. So you have received some benefits or some amount, some deduction, okay, some allowance. So because of that you are getting some amount. That amount, the value of the benefit you are getting in the subsequent previous year, in one previous year you have received some deduction, some allowance, and the subsequent previous year you are getting some income out of it through sales or transfer, whatever. And if you get such an income, that income is chargeable under PGBP. Deduction of any loss, expenditure, trading liability was allowed in earlier years, and during the current previous year the assessee has obtained refund of such expenditure or some benefits in respect of such trading liability by remission, then meaning the reduction and cessation or stopping of something, and because of that you are getting some income of such liability. Then such refunded expenditure or remitted ceased liability shall be deemed to be the income of the assessee in the previous year in which the amount is recovered. The liability is remitted. Example is section 35D, scientific research. You will learn more about this section in the coming sections. The provisions hold good even when the business or profession for which the deduction has been made cease to exist, even though the business is not in existence present in the subsequent year. Even then the provision holds good. The allowance or deduction must have been made previously while computing taxable income. Okay, now actually you would have already, the deduction must have done from the income in some previous year while computing the taxable income. Then only it is considered as income when you receive some amount out of such assets. Where benefit has been obtained by successor of a business, such benefit shall be taxable in the hands of the successor. Now that you have transferred your business, so you have a successor. Okay, so through amalgamation or through a demerger, merger, or by transfer, that your business has been transferred to some other person, or maybe some other directors or another company. So if that is the case, if such benefit is obtained by the successor, it is taxable under the hands of the successor. Amalgamation means actually one or two companies coming together forming a new company, and the amalgamated company is the successor. And it can have many forms. Demerger means one company is split into more than one company. One company is split into multiple companies, and that asset will be transferred to one particular company. So who possesses that, or who is the owner of that asset, he may be getting that benefit out of this, and he is the successor of, as far as that asset is concerned. Recovery after discontinuance due to death or retirement of the person carrying on such business or profession. Okay. Death or retirement of the person carrying on such profession, and recovery after that we are getting. Then as per section 176(3)(a) and 4, any sum received shall be deemed to be income of the recipient and chargeable to tax in the year of receipt. Whoever is the recipient of that income, he is liable to pay tax for that. In case there is a successor, the successor will be liable to be taxed for any such benefits received by him in the subsequent previous year. Successor in business, if amalgamated, the successor will be the amalgamated company. If succeeded by another firm, the successor will be the other firm, the partnership, maybe some partnership firm is succeeded by actually another set of partners. One partner was removed, or maybe new partners are joined, then they remove the old partners. Then the successor will be the other firm, and that new firm with the new partners is the successor of the company, and they are liable for the income received. If one person is succeeded by another person, the other person will be the successor. In case of proprietary, for example, the company is transferred from father to son. In that case, the son will be the successor. In case of demerger, when one company is split into two or more companies, then the successor will be the resulting company. Means actually the company to which the asset is transferred. Demerger is when a company splits off one or more divisions to operate independently to be sold off. It is the converse of merger. Remission cessation of a trading liability includes remission cessation of liability by a unilateral act of the assessee by writing off such liability in his book of account. Now the trading liability is written off, maybe some bad debts or something. It's written off by the assessee himself unilaterally. Then the trading liability is still valid for him. Section 41(2), balancing charge, chargeable to PGBP in the case of power sector undertakings. Power sector undertakings. Straight line method of depreciation to be followed by power sector undertakings. Depreciation claimed for building, plant and machinery under section 32(1)(1), sold, discarded, demolished. For the power sector undertaking, straight line method is followed. They can follow straight line method or WD method. But actually, if they want, they can change, or they can opt for SLM method also. SLM method or WD method. This facility is only for power sector undertakings. Other undertakings will not be allowed to take SLM method for depreciation. Okay. Other companies or undertakings has to follow WDV method compulsorily. So in the case of power sector undertakings, balancing charge is when sale value is more than WDV and sale value is less than the actual cost of assets. Then the difference between sale value and WDV is the balancing charge, and this is chargeable to PGBP. Here we have taken, for example, that actually the sale value plus scrap value we have to take, but actually scrap value I have taken 0 in this case. That's why I have not mentioned the scrap value here. For example, now we take a case where sale value is 5 lakh. Scrap value will be considered 0. And WDV, let us assume WDV is 4 lakhs. Okay. And the cost of asset is, let us assume it is 5.5 lakhs. Now in this case, the sale value is greater than the WDV. Okay. And sale value is less than the actual cost of asset. Then say the difference between sale value and WDV is the balancing charge and is chargeable to PGBP. Here what it is being said is actually at the cost after after deducting the depreciation, WDV is coming. Okay, WDV is coming after deducting the depreciation. So the value that we may get for that asset is maximum we may get is WDV. But we have sold at a price more than the WDV. So the cost of asset was 5.5. From that actually 1.5 lakhs was received as depreciation during these years. Now the balance as of today is 4 lakhs. Now when we are trying to transfer the asset, we are getting a value of 5 lakh sale value. That means more than the worth of the asset, WDV. So there is a difference of sale value minus WDV is 1 lakh. That is a profit. So because you are supposed to get maximum of 4 lakh only for that asset. Above the 4 lakh WDV, whatever amount you are getting, that is a profit only. So it is a balancing charge and is chargeable to PGBP. This case is valid only in the case of power sector undertaking, which is following SLM method. Okay. When some asset or plant and machinery or power sector undertaking, which is following SLM method depreciation, is sold, discarded or demolished. If you are getting some balancing charge, that balancing charge is chargeable to PGBP income. Now, second case, sale value is greater than the actual cost. Here, the actual cost we are considered 5.5 lakhs. Now, the sale value, the second case, what we are is actually 6 lakhs we sold it. Okay, scrap value is 0. Actual cost we know that 5.5 lakhs. And here, sale value 6 lakh is more than the actual cost of 5.5 lakhs. So there is a difference of 0.5 lakhs, which is considered as actually short-term capital gain. So the difference between the sale value and the actual cost is short-term capital gain. And the actual cost is 5.5 lakhs. WDV we know that is 4 lakhs. Actual cost is 5.5 lakhs. And the difference between the actual cost and WDV is the balancing charge and chargeable to PGBP. And the difference between the sale value and the actual cost, the positive difference, that is charged to short-term capital gain. So up to the actual cost, it is chargeable to PGBP, and above the actual cost, whatever profit we are getting will be chargeable to capital gain, short-term capital gain. If the sale value is less than the WDV, for example, when we sold, we got only 3 lakhs. WDV, as we know, is 4 lakhs. So the sale value is less than the WDV. Then actually the difference is the terminal depreciation. Now there is actually a loss, to be frank, because actually we are supposed to get 4 lakh for that asset, but on marketing, on selling it in the market or transferring, we get only 3 lakhs. So there is a shortage of 1 lakh. This is called terminal depreciation, and to be shown as an expense in the P&L. The expense of the PGBP is P&L. Okay. And it should be shown in the book of accounts also as a loss. The year of taxability is the year of sale or transfer. Example, let us see an example. Let the actual cost is 5 lakhs, opening WDB is 2.5 lakhs. Now, in the SLM method, you know that how the SLM method actually depreciation is calculated. What is depreciation? Depreciation is equal to cost divided by the life of the asset. Okay. Now it is actually 5 lakhs is the cost. Okay, and 5 years in the life, it is actually 1 lakh. 1 lakh per year is the depreciation. Okay, and since it is SLM, it will be the same always. We get all 5 years, 1 lakh will be charged as depreciation for 5 years, and you will get, provided here actually that scrap value is 0. Okay, if there is a scrap value, then it will be the cost minus scrap value you will get, and that will be divided by the life. That will be your depreciation. Okay, now here let us assume that the actual cost is 5 lakhs and open WDB is 2.2 lakhs. Scrap value, let us assume 0. Then the sale value, you consider 3 cases. Case 1. What is the case 1? Case 1, sale value is 2 lakhs. Actually, the WDB is 2.2 lakhs, but sale value is only 2 lakhs. Now, what happens if the sale value is less than the WDB? So, the difference is 0.2 lakhs, which is the terminal depreciation, and it is a PGBP expense and charged to profit and loss account as an expense. Okay. Now, under section 32(1)(3), written off in book of accounts. It should be written off in the book of accounts. Okay. WDB left after sales. Now, let it be sale value be 3 lakhs. Then that means it is more than the WDB. So then the sale value minus WDB, we are getting 0.8 lakhs, which is the balancing charge and is chargeable under PGBP as an income. Okay, as per 41(2). Section 41(2), we have discussed it actually. Under 41(2), we have discussed the balancing charge. Okay, now let the value be 5.5 lakhs sale value. Then the 5.5 lakhs minus 5 lakhs is 0.5 lakhs is short-term capital gain under section 50A. Short-term capital gain is discussed in 50A. Okay, now this is up to the cost of the asset. Now the cost of the asset minus the WDV, whatever we are getting is the balancing charge to be treated as PGBP. And then that means there is 2 parts in this. Okay, in this case there is 2 parts. One part is up to cost of asset. Second part is actually above cost of asset. Whatever we get above cost of asset is short-term capital gain, and whatever we get up to cost of asset is the balancing charge. It is charged charged under PGBP. Okay, clear. Another example we will see. Asset cost is 1 lakh, life is 10 years, it is SLM. Then depreciation, let us assume the depreciation is 10%. That means such a 10% depreciation means actually 10,000 per year. Okay, depreciation 10 years. So it is 10,000 per year depreciation. Now we use for 2 years. That means actually 20,000 rupees deducted for received as depreciation. Okay, that is deducted from the cost. So WDV as per as on this previous year is actually 80,000 rupees. Okay, for 2 years 20,000 is deducted. Now it is 80,000 rupees. So the present WDV is 80,000. The previous year 24, 25. Now where the sale value is less than the actual cost or equal to actual cost, up to actual cost of 1 lakh, up to 1 lakh. Okay, so it is less than. Now the sale value is only 70,000. So WDV is more than the sale value. It is 80,000. So 80,000 minus the 7,000 will give 10,000 is the terminal depreciation, because actually the sale value is less than the WDV. In the case 2, sale value is more than WDV. WDV is 80,000 and sale value is 90,000. So sale value minus WDV is 10,000, which is the balancing charge. Under section 41(2), it is the PGBP income. So when sale value is more than actual cost, it is more than the 1 lakh. It is 1,10,000. In this case, up to 1 lakh. Okay, actual cost minus WDV, that means 1 lakh minus 80,000 is 20,000. Under section 41(2) is PGBP income. Now excess of the actual cost means more than 1 lakh. Okay, that is 1,10,000 is there, so 1,10,000 minus 1 lakh actual cost will be 10,000. It's a short term capital gain under section 50A. Okay. Now let us consider one question. It is Tata Power Limited is a power generating unit, and the company has purchased one plant and machinery on 1/6/2015 for 20 lakhs. And the same was put to use on 1/12/2015. The company has opted to follow SLM method, and the rate of depreciation prescribed under the Income Tax Act is 8.4%. In this case, the depreciation amount shall be for previous year 2015-16. I mean, already it is given the depreciation from, the rate is 8.4%. Therefore, the actual cost is 20 lakhs. So, for the previous year 15-16, it will be 20 lakhs and 8.4%. Since actually it is put to use on 1/12/2015. Here, one thing we should know is that put to use means actually you might have purchased it before, but the asset when actually used in the production, or maybe put to use for the production or in the business, if it is less than 180 days, this up to 170 days, only 50% only depreciation only we can give. Okay, only 50% only we can give. Now that means actually for the previous year 1/12/2015 means it is actually from from 1/12 mean the December, January, February, March, only 4 months. It is anyway it is less than 170 days only, so only 50% only they will get as depreciation. But this is for the first year only, for the first year of the purchase. That year only, if it is less than 180 days, they will get 50%. These things you will learn in section 32 under depreciation. Now you will learn it. Now actually I am telling you for your benefit only now, just to get to know or just to solve the problems only. I am just telling these things to you. Okay. Now the first year they get only 50% because it is not used for 180 days. Less than 180 days only used. That's why it's getting like that. So first year you will get 84,000, and second year 16-17 you can use it full year. You are using it, so you are getting full depreciation. So you are getting 8.4% of 20 lakhs, 168,000. Third year also you are getting 168,000. You are getting, okay. Because since it is SLM method, no need of deducting it from the previous years. That you will do actually, but because actually for calculating the depreciation it is not required. Okay, but if it is double digging method, you have to multiply the depreciation with the WDV, not with the actual cost. But each year, for finding the depreciation, we have to multiply with the actual cost only. Okay. So let us assume that now it is told that the company has opted SLM method, rate of depreciation prescribed under the Income Tax Act. The depreciation amount will be like this. For the second year, it is like the first year it is 50%, second and third year 1.68 lakhs each. Let us assume that this plant and machinery has been sold on 1/11/2018. Now 1/11/2018 means actually after this 1/4/18. Okay, now up to 1/4/18 the depreciation we calculated, and it is sold on 1/11/2018 means it is less than, okay, 1/11/2018 only it is sold. WDV of this P&M as on 1/4/2018 is, we have to add all the three together. We will, and we have to deduct it from, we have to add all these three, and we have to deduct it from 20 lakhs. So 168 plus 168 plus 84,000, and we deduct it from 20 lakhs. Then we will get 15 lakhs 80,000. Case 1, the plan has been sold for 9 lakhs. So we are calculating the WDV. How will we calculate WDV? As I told, 20 lakhs minus 1.68 lakhs minus 1.68 lakh minus 84,000. So what we are getting is 15 lakhs 80,000. Okay, correct. So, first case, let's assume that plant has been sold for 9 lakhs. In this case, WDV is 15 lakhs 80,000, then sale value is 9 lakhs. So, difference is 6 lakh 80,000. 15.8 lakhs minus 9 lakhs is actually, because it is sold at a rate less than the WDV, then it is terminal depreciation. Case 2, sold at 18 lakhs, mean more than WDV. WDV is only 15.8 lakhs. Then the difference is 2.2 lakhs, and which is actually the balancing charge. The third case is actually plant has been sold for 23 lakhs, that means more than the cost. That means there is 4,20,000 shall be termed at the up to 20 lakhs, the balancing charge. Okay, that means actually 23 minus 20 lakhs would be treated as capital gain. Okay, 3 lakhs will be treated as capital gain, 23 minus 20 lakhs. And the 20 lakhs minus 15.58, sorry, the sale value 23, okay, 23 lakhs, sorry, 20 lakhs minus 15.8 lakhs, that is 4,20,000, that will be the balancing charge, and 23 minus 20 lakhs will be the short term capital gain under section 50A. Now to calculate terminal depreciation, what we will do, calculate the return on value, WDV, or the depreciable asset on the first day of the previous year in which such asset is sold, discarded, demolished, or destroyed. So the first day of the previous year in which such asset is sold, discarded, demolished, destroyed, whatever, you find out the WDV. Ascertain net sale consideration if value as per 1, that the WDV is greater than the sale value, there is a loss. As per 2 means the sale value, the net sale consideration. If a value is actually the net sale means such a sale value minus the cost of sale, whatever, you will get the net sale consideration. So if the WDV is greater than the sale value, or sale value is less than the WDV, then there is a loss actually, then that is called terminal depreciation. Sale consideration is money payable to the taxpayer in respect of such a depreciable asset, and plus scrap value if any. Okay. So as we discussed, the sale consideration is the money payable to the taxpayer in respect of depreciable assets or scrap value if any. Net sale consideration is actually sale consideration minus expenses on transfer. What you might have incurred some expenses for sale. That sale consideration, that expense is to be deducted from the sale consideration, and you will get the net sale consideration. That is to be considered. Sale consideration is the actual money received or received in cash or by check or by draft. It excludes any other thing or benefit which can be measured and converted in terms of money. If the asset is sold or discarded in the previous year in which it is first put to use, any loss on transfer of that asset shall be treated as capital loss and not as terminal depreciation. To be treated as capital loss and not as terminal depreciation. Okay. For example, you have purchased an asset in the previous year 24-25. Okay. Maybe you purchased in October. Okay. October 24. And you put to use the same asset in June 25. That means in the next previous year, subsequent previous year, you put to use. So in the same previous year, October 25, you have sold it. That means the year in which it is put to use, the same year it was discarded or transferred. If this is the case, in the same previous year, it was put to use, it was discarded, then okay, the loss you incur, maybe you have purchased for 5 lakhs and discarded or sold for 3 lakhs, then there is a difference of 2 lakhs is there, and this, okay, and this loss, whatever loss is there, this is treated as capital loss and not as terminal depreciation. The asset must be used by the assessee for the purpose of business or profession, at least for some considerable time during the previous year in which the transfer or sale takes place. Temporal depreciation can only be allowed if the asset is completely written off. For allowing temporal depreciation, asset should be completely written off from the book of accounts. Okay. Now, balancing charge under section 41(2) and capital gain under section 50A. So just we have discussed the same thing. Okay. This is the same thing only. We are actually instead of the cost, we are saying net consideration. Cost consideration we are saying. Okay. Nothing else. So now let us solve one question. In this, CH Power Project is a power generating unit. On 2/4/23, it purchased a plant for 50 lakhs and eligible for depreciation at the rate of 50% on SLR. Compute the balancing charge or terminal depreciation assuming the plant is sold on 21/4/25. Okay, it is purchased on 2/4/23 and it is sold on 21/4/25. Now, how we will consider the work? Now, actually, there are three charges are given. They are sold for 33 lakhs, 47 lakhs, 55 lakhs. Three sale values are given. Okay. Now, ABC we are considering WDV as on 1/4/23. WDV is the same. 1/4/23 is given WDV at 15% means actually see 1/4/23 50,000 into 15%. Okay. 2/4/23. 2/4/23 means is more than 180 days. Okay. It is actually that second day of April. Means the full year is there. Of course, it is more than 180 days, 179 days, or more, or only 180 or more. Since it is more than 180 days, you will get the full depreciation. 15% you will get. So 2 year. 2/4/23 2. Okay, 2/4/23 you are saying the full year you are getting. Then from 1/4/24. Okay, 1/4/24 to 1/4/25. Second year. 2 years are there. So you consider the 50 lakhs into 2 into 15%. It is actually 15 lakhs. So the 50 lakhs is the 50 lakhs is the depreciation. So you have to deduct it from actually the 50 lakhs. 50 lakhs minus 15 lakhs, 1/5. Then we will get 35 lakhs. The WDV is the same as on 1/4/23. WDV is the same. Is it 1/4/23 or what? No, it is not 1/4/23. Actually, it is wrong. As on 1/4/25. Okay, WDV as on 1/4/25. No, it is correct. As 2/4/23 is the date in which it is purchased. So, okay, it is actually 1/4/25. 1/4/25, the WDV is 35 lakhs. So, let us assume that first case 33 lakhs. It is sold. Now, it is less than the WDV. Sale value is less than WDV. The 2 lakhs is there. That is the terminal depreciation. Second case, it is 47 lakhs is more than WDV and less than the actual cost. Therefore, whatever we are getting will be the balancing charge, the difference. Now, third case, it is actually more than the sale value, more than the cost. So, up to 50 lakhs we are taking, that 50 lakhs will be the balancing charge and the balance 5 lakhs will be the short-term capital gain. Okay. Now, let us go to section 41(3). Sale of assets used for scientific research related to business. The scientific research is actually explained in section 35. Okay, that we will learn in the later sessions. Okay. Now, scientific research. Both revenue and capital are 100% allowed in the case of scientific research, except land. Natural science, applied science, agriculture, animal husbandry, fisheries, social sciences, statistical research, expenditure for acquisition of rights for scientific research. Okay, all these expenditures are, all these kind of expenses are actually allowed in scientific. This is 100% allowed. Amount realized on transfer of assets used for scientific research is chargeable under PGBP. Why? Because already 100% is allowed. Okay, deduction allowed. So they have already taken the benefit of the scientific research. Now, whatever amount they are getting is an additional amount. It's an income for them only. Whatever they're getting, already deduction allowed while calculating the income or profit and loss. Now, whatever amount they're getting, by transferring the assets they have acquired for scientific research. On transfer of the assets, whatever amount they are getting, it is chargeable under PGBP in the year of sale, over of the deduction allowed under 35(1)(4) and the sale proceeds. So whichever is lower, sale proceeds what they are getting is lower, then that amount is allowed, and if the deduction they received under 35(1)(4) is less, that amount is allowed, without having been used for other purposes. There are two cases. One, actually it is not used for other purposes. Actually, from scientific research, actually it is directly sold. They are not used in business. Sale consideration to the extent of the cost of PGBP income excess over the original cost is taxable in the capital gain under section 45. So sale consideration to the extent of cost, just like we just considered, okay, just like balancing charge, up to cost it is PGBP, then above cost is capital gain under section 45. After being used for other purposes, sale consideration shall be subtracted from the relevant block of assets. In this case, at the time of conversion to normal business asset, the cost of acquisition shall be nil. There is no cost for the asset. When it is used, that asset purchased for the scientific research, when it is used in normal business, actually there is cost of acquisition is nil. Therefore, there is no depreciation allowed for that. Okay. So there is no cost of acquisition at the time of conversion. Sale consideration shall be subtracted from the relevant block of assets in this case. Now, scientific research, during scientific research transfer to, while it is used in scientific research, it is transferred to business. Then, after completion of the use of scientific research, it is sold. So, in the first case, when it is transferred to business, cost of acquisition is nil. Then it is subsequently sold or transferred. The selling price income charged as per 41(1) towards recovery of deduction. Year of taxability is the year of transfer or sale. The selling price is the income charged as per 41(1) towards recovery of deduction. Okay, whatever amount is actually deducted, that is actually charged under PGBP. Now, sale proceeds in the second case, PGBP income as per 41(3), the lower of the deductions under scientific research or sale price in this case. So it is a PGBP income. Directly it is actually after use in scientific research it is sold, then it is a PGBP income directly. Section 41, clause 4. Any amount of bad debt recovered in full or in part for which allowed deduction under section 36(1)(7) in any previous year will be income under PGBP in the year received. So we have been allowed some deductions for bad debts. Okay. Now we have written off maybe 1 lakh, and the assessing officer of income tax allowed only 60,000, and that 60,000 only will be considered as bad debts. So the PGBP income, and in subsequent year we may be recovering some amount. Okay. Now we have recovered 30,000 rupees in subsequent year. Maybe after 3 years or 4 years, already it is allowed deduction for 60,000. 40,000 is disallowed. 30,000 was recovered after some years. Then the bad debt recovered. In that case, this 30,000 will be deducted from the disallowed amount 40,000, and 10,000 will be treated as disallowed amount, and there is no tax for that. Okay. Now, more than that amount, disallowed amount is deducted, then the difference can be considered as income. PGBP income taxable is a bad debt recovered minus bad debt disallowed by AO. Now 40,000 in the present example, now 30,000 recovered, then bad debt disallowed by AO is 40,000. Then it is actually 10,000 difference is there. Okay, so a difference of bad debt claimed and allowed by AO is disallowed. Year of taxability is the year of recovery, where the deduction has been allowed in respect of bad debt, and the bad debt is subsequently recovered. Then the amount so recovered shall be deemed to be the income when the deduction has been allowed in respect of bad debt and the bad debt is subsequently recovered. Now, okay, now actually 60,000, now I think the bad debt, 40,000 bad debt is recovered. For example, 1 lakh, we have claimed 60,000 allowed, 40,000 disallowed, then 40,000 recovered. That means actually there is no tax to be paid then, because actually the disallowed amount only deducted. After that, maybe after 1 year, we have recovered 10,000 more. That means actually that 100% amount is allowed now. This 40,000 plus 60,000 already allowed. Now whatever we are getting is income. The 10,000 we are receiving again, that is an income under PGBP. When reduction has been allowed in respect of bad debt and bad debt is subsequently recovered, then the amount so recovered shall be deemed to be the income under the PGBP of the previous year in which the amount so recovered. Subsequent recovery. Okay. Now section 28 and 40, section 41 are there. Then gross business income we are calculated. Then less deduction under section 30, 37. Okay. Then the taxable income we are calculated. Then subsequent recovery has come. Okay. This shall apply even if the business profession is no longer exists in the previous year in which recovery is made. Now let us consider an example. Rupees 1 lakh is recoverable from a debtor, Mr. A. The assessee writes off 40,000. Writes off 40,000 as bad debt in the previous year, 31/3/2019. Subsequently, in the previous year, 31/3/2025, 70,000 was recovered from Mr. A. Here, rupees 60,000 shall be deemed to have been recovered towards the debt and 10,000 towards the recovery of bad debts of 40,000. What it means is actually that only 40,000 is written off. 60,000 is not written off. Therefore, when 70,000 received, okay, 60,000 when 70,000 received, $60,000 is deemed to have been recovered because already 40,000 is written off. Then 60,000 is to be recovered. Therefore, out of the 70,000, 60,000 is recovered. Now balance 10,000 is there. And this balance 10,000 will be treated as income in the previous year, 24-25, under PGBP. Already the 40,000 is written off and actually we have taken deduction on that. That is the reason why we are taking the 10,000 as an income. So 10,000 towards the recovery of bad debts of 40,000 and 10,000 will be treated as income in the previous year 24-25 under PGBP and taxable under section 41(4). So let us consider how it is accounted. Now A is a debtor actually. Now actually you can consider actually 1 lakh to sales. A is debtor. A debtor 1 lakh to sales 1 lakh. Then bad debt 40,000 to A. That is to be accounted in profit and loss also. Profit and loss account debtor 40,000 to bad debt 40,000. Now when we recover 70,000, bank debt 40,000, okay, to A 60,000 and to 10,000 is actually bad debt recovery. Now bad debt recovery debtor to P&L, that is also accounted in the P&L, and it is a profit, income under PGBP. Now there are 2-3 case laws we will mention here. This one case law was actually PK Kaimal. Now as per this, the bad debt of the predecessor recovered by successor is not an income for the successor under PGBP. As per this verdict, the bad debt of a predecessor recovered by the successor is not an income for the successor under PGBP. Okay. Second case is actually Veerabhadra Rao. Second case. Second case is Veerabhadra Rao. The bad debt was written off by predecessor and has shown as an income also in P&L. The successor can claim deduction. The bad debt was written off by the predecessor and the successor can claim the deduction even if not shown as an income by him. Whatever bad debt written off by predecessor, and since it is written off, the successor can claim deduction even if it is not shown an income by him. Now another example, we can say actually bad debt 50,000, deduction allowed is 20,000 by the assessing officer, disallowed 30,000, subsequent report is 40,000, then taxable income is actually the 40,000 disallowed. From that 30,000 is recovered. Sorry, disallowed 30,000, recovered 40,000. That means the difference is 10,000. So the first the disallowed amount will be deducted and the balance is taxable under 41(3). Therefore, we received 40,000, disallowed 30,000, and the difference is 10,000. That is chargeable under PGBP under section 41(4). Now the recovered amount is only 20,000. Then since the disallowed is 30,000, 30,000 minus 20,000, 10,000 will be only, instead of 30,000, 10,000 will be disallowed, and there is no tax liability. Hence, 20,000 is allowed. Now, section 41(4)(a), amount withdrawn from a reserve created under section 36(1)(8). That is 41(4)(a). Anticipated losses, expenses, no deduction are allowed for anticipated losses. That is the reserve that you are saying. Then the amount withdrawn from a reserve created under section 36(1)(8). Anticipated losses and expenses, no deductions are allowed for anticipated losses. Example, provision for bad debt, doubtful debts. The provisions are not allowed. Okay. Capital expenditure are not allowed as deduction. Provisions are not allowed as deduction. Capital expenditures are not allowed as deduction, except specified business, except in the case of specific businesses. Expenditure on non-accessible business, not allowed. Example, expenditure for earning agricultural income is not allowed as deduction because the income is not accessible. Business expenditures must have been incurred by the assessee to get deduction. For get deduction, the business expenditure must have been incurred by assessee. Allowed for own business also if incurred even when the benefit is enjoyed by others. Okay, it is allowed for own business also. So there should be some business expenditure, then only it will get deduction. Notional expenditure. No one can earn income from himself or herself. For example, rent to sole proprietor or salary to proprietor is not allowed. Onus of proof lies with the assessee. So it is the responsibility of the assessee to give proof for the deductions. Rent from house property, taxable under house property under section 22, not under PGBP. However, if letting out house supports the smooth operation of the business, incidental to business, then it is taxable under PGBP. Dividend on shares, taxable under section 56(2)(1), income from other sources. Dividend on shares are taxable under income from other sources, even if shares are stock in trade. The provision is not applicable to interest on securities held as stock in trade. Winning of lotteries and races. This is taxable under income from other sources. But when lottery tickets are treated as stock in trade, any winning from unsold ticket is a PGBP income. For example, there is a distributor, sole distributor, and the sub-distributors of lottery tickets. As far as the distributors are concerned, if they are getting some income out of the unsold ticket, they win some price, that is considered as a PGBP income for the distributors. But as far as the customer is concerned, if they win some tickets, actually it is a income from other sources. But for a inventory, it is PGBP income, exempted income. By virtue of section 10, death cum retirement gratuity, DCRG, and PF, HRA, all are exempted incomes. Some taxable under head capital gains for the purpose of section 28(5)(a) shall not be taxable under this head. So, the sums taxable under the head capital gains shall, for the purpose of section 28(5)(a) shall not be taxable under this head. Income from illegal business is taxable under PGBP. Specific deductions, section 30 to 43 dB, this is also chargeable under 430 dB, under PGBP. Now, there are some income which are not chargeable under PGBP. The following incomes, though in the nature of profits and gains, business or profession, shall not be chargeable under PGBP. Rent from house property is taxable under section 22 under the head income from house property, even though the assessee is engaged in the business of letting out properties on rent, or such property is held in as stock and trade for builders who rent out completed buildings. For them also, it is house property, it is not PGBP income. If it is inventory. Even if it is inventory for house property, even if it's inventory, it is a PGBP income. Sorry, it is not a PGBP income. It is income from house property. Not. However, where the letting out of house supports the smooth running of business, that incidental business, then such income can be treated as business income. Dividend on shares is taxable under income from other sources, even though the assessee deals in shares and such shares are held as stock in trade. The provision is not applicable in the case of interest on securities held as stock in trade. The shares, if you consider for investment, it is actually sale is capital gain and dividend is income from the other sources. And if it is stock in trade, for sale it is PGBP and dividend it is income from other sources. So securities, debentures, bonds and all, the investment for investor it is sale is capital gain and interest is income from the sources. And for stock in trade, sale is capital gain and interest is income from the sources. Winning from lottery, races, etc. are taxable under the head income from the sources, even if such income is derived through regular business activity. Treatment of lottery tickets held as stock in trade. We have discussed the same point before also. Winning from unsold tickets held as stock in trade shall be treated as incidental to business and taxed under the head PGBP. Extended income by virtue of 10, that is DCRG, then actually gratuity, PF, then HRA, all these are exempted. Some taxable under the head capital gains for the purpose of section 28(5)(a) shall not be taxable under PGBP. Example, profit on sale of a route permit shall not be taxable under the head PGBP. Okay, and this 28(5)(a), let us see what this 28(5)(a) is. 28(5)(a) deals with 28(5)(a) non-compete fee. Okay, non-compete fee. So, non-compete for not carrying any business. So, it is actually PGBP income. But actually, that sum received for transfer of rights is a capital gain. So, some taxable under the head capital gains for the purpose of 28(5)(a). That means actually, if you are getting some income for selling of rights, that shall not be taxable under PGBP. So that here actually another one example given is profit on sale of route permit. It's for some rights they are transferred. It is not taxable under the PGBP, it is taxable under the gain, capital gain. In this section, we are going to explain the expenses which are specifically allowed. Section 29 says, the income referred to in section 28 shall be computed in accordance with provisions contained in section 30 to 43D. That is actually whatever income to be charged under PGBP and how it is computed is shown in section 30 to 43D. So section 30 to 43D will explain how the computation is done for the incomes in section 28. So section 30 to 36 will give specific allowances and 37(1) is the residuary section which explains what is left behind. That means which is not covered in section from section 30 to 36. So section 30 to 37 is admissible deductions and section 40 will be inadmissible deductions, and the expenses which are deductible in some circumstances are covered in 40A and deemed expenses in 41, and the rest of the things will be dealt in the balance sections. When we talk about expenses, the expenses can be specifically allowed, specifically disallowed, deemed expenses, special cases of expenses, and the miscellaneous expenses as we have seen above. In the P&L account, if some expenses are not allowed, then which is not allowed shall be added to the profit to compute the PGBP income. Now let us go to section 30, which says deductions for rent, rates mean taxes, local body taxes, and other taxes, central and state government taxes, repairs and insurance for buildings, for buildings used in business or profession. Okay, it's a repetition. Okay. Now it deals with what are the allowed expenses for building. Okay, and how the deductions of rent, then taxes, then repairs, insurance are handled, computed. What are the allowed expenses? In case of a building, there can be different expenses like rent, then revenue repairs, means current repairs, some repair and maintenance of the revenue nature. Then there can be capital repairs can be there. Then actually of course the municipal tax, other taxes will be there for the building. Then of course there is insurance or premium. So rent, if you are considering, if it is paid by the tenant, okay, then it is rent paid by the tenant for the building occupied for his business. For his business he has taken some building on rent, then that expense is allowed. Then the repair and maintenance, revenue repair and maintenance, current repairs done to the owner or the tenant or the lessee, okay, licensee, mortgage with possession, irrespective of the amount involved, that current repairs are allowed. Even a lessee or a mortgage or a mortgagee is actually considered as an occupant. Capital repairs. Capital repairs for tenants allowed if it is a deemed building and depreciation is allowed accordingly. Deemed building means actually you have taken as a long-term lease. For example, some building is taken for 30 years lease. Then actually whatever repairs, even capital repairs also, to be done by him. Then it is a deemed building. Okay. Such case, capital repairs are allowed. Otherwise, it is not. For the tenant. And in case of the owner, the capital repairs are capital expenses of the building and to be added with the cost of the building. And of course, depreciation is allowed for that. Then right and taxes, land revenue, local taxes, municipal taxes, cesses, and taxes levied by foreign government, by owner, as per cash basis, whatever. All these are the taxes on the building are also allowed. But it is subject to section 43B in the case of accrual basis of account. If the business or the firm or the organization is following accrual method of business, basis of business accounting, then 43B is applicable. We will discuss about 43B. Okay. Now, then for insurance premium, insurance for risk, damage or destruction of premises paid by owner or tenant, whatever, whether by owner or tenant, it is allowed. Insurance premium is available. So taxes, insurance, then revenue repairs, capital repairs, rent, all these expenses are allowed based on the specific conditions. Now the taxes are allowed if the tax is actually paid. Okay, in the accrual basis of system. Now if you are taking PGBP accounting, it can be cash basis or accrual basis. Cash basis means actually the payment, the cash is to be received, actually to be paid. Okay, then only it is, cash is to be actually paid, then only it is a payment basis, then only it will be accounted. And in accrual basis, the expenses incurred, whether paid or not, or the sales or the income accrued, whether received or not, are actually accounted in the books of accounts. So as per 43B, notwithstanding anything contained in any of the portions, a deduction otherwise allowable under this Act in respect of any sum payable by assessee by way of tax, duty, cess or fee, whatever name called, under any law for the time being in force, shall be allowed. Okay, when only in computing income referred in section 28 of the previous year, the sum is actually paid by him. This is the main point. Okay, now what we should know is that this amount is to be actually paid. What 43B says? 43B says actually such expense, the taxes, okay, tax, duty, cess, fee, extra are allowed. Allowed when? Allowed in computing the PGBP income. Okay, referred in section 28, if when such sum is actually paid by him, that's what section 43 say. So accrual system, when you are following, normally what do you do? Even if it is not paid, okay, when it is due, it is shown as expense, and the expense incurred. When it is due, it is paid as, it is actually shown as expense. But in the case of taxes, it is not allowed. Only when you pay it, then only it is allowed. This is what 43B says. Okay. So that 43B is applicable for accrual basis of accounting, and municipal taxes are on payment basis only allowed as per 43B. If the owner himself uses the premises for the business, no notional rent would be allowed. Okay, I am running a business, I am a proprietor. In my home, in a room, I am doing a small business. Okay, I am a proprietor. Then I cannot charge rent for that room or building, whatever. In my own building, if I am doing a business, okay, then actually I cannot charge the rent, okay, on a notional basis, I can say, because I am not receiving any rent at all. Not receiving any rent. Okay. So the rent we are not receiving. So just I am showing that actually I received rupees 10,000 as rent and showing the business is not allowed. If the owner himself uses the premises of the business, no notional rent would be allowed. No notional rent. Okay, not without actually being paid. You cannot say that I have incurred expenses for 10,000. It is not allowed. The received by the owner will be income from HP. It is not a PGBP income. Okay, for a firm, in the case of a firm, reasonable rent occupied by the business owned by one of the partners is allowed. Now there are two partners or three partners are there in a firm, and business is conducted in one of the partners' building, and for that he can charge a rent, but that rent should be the house property income. This is not PGBP income. Then, okay. Now a firm, if rent is paid for using the building of one of the partners, okay, then that will be PGBP expense. As far as the partner is concerned, that is a house property income. For premises used partly for business, proportionate expenditure for business is allowed. Okay, now, okay, one building is being used and part of the building is used for the business, part is used for other purposes. Okay, and if it is only partially used, the rent is allowed only for the portion used for the business. Now, for example, rent paid in 24-25 is 2,40,000 per annum. If only 70% is used for business, the allowed deduction is only 70% of 2,40,000. That is 1,68,000. Okay. So, for premises used partly for business, proportionate expenditure for business only allowed. Deduction in case of subletting of rented premises. Now, we have taken a building on rent for the business, but a portion of the building we are subletting, okay, to some other business. So, in case of subletting of rented premises, the rent paid minus rent received from subletting, it to be considered. So, whatever income we are getting out of subletting, that amount is to be deducted from the rent paid. Then only for that amount deduction is allowed. Rent paid for profession for previously 24-25 is 1,80,000 per annum. 1/4 portion is sublet for another person for 3,000 per month. Then the net deduction will be 1,80,000 minus for 12 months at the rate of 3,000, 36,000 to be deducted from that. Then we will get 1,44,000. In the case of repair and maintenance, current repairs are only allowed. For capital repairs, only depreciation allowed. Okay. So, now current repairs are only allowed, for capital repairs only depreciation allowed. Now tenant, if for a tenant, current repair is a revenue expense, P&L can be charged. For owner or landlord also, current repair can be charged in the P&L as a revenue expense. As far as capital repair is concerned, if it is a deemed building, depreciation allowed for him, for the tenant. And for the owner also, if capital repair is done, that will be added to the cost of the building as capital expenses and depreciation is allowed for him. So the point to be considered here that no capital expenses is allowed, capital repair is allowed. Only the depreciation on allowed capital repair is only allowable here, only deductible. Okay, so only depreciation is allowed. The capital expense is not allowed. Now relevant case laws. Now we are doing painting for our building. Is it a capital expense or revenue expense? So it is, the painting is to be done maybe once in 3-4 years or so. Maybe the building may be worth the 10 lakh, book value maybe 10 lakhs. Maybe after so many years depreciation, 30-40 year old building. Okay, so many years depreciation, maybe 5 lakhs or 10 lakhs, maybe 5 lakhs. But if it is a big building or so, when you are doing the painting, it will be more than the book value. It can go maybe 7 lakhs or 8 lakhs. Okay, so we cannot say actually, okay, it is to be added to the book value or the of the building, or it to be added as capital expenditure. Like that, it is not possible. It is a revenue expenditure. Now, fluctuating items like share of profit cannot be treated as rent. Now we are saying actually that okay, you are making an agreement that actually that rent will be certain percentage of the profit, but the profit is a fluctuating item. It is not fixed, so it is not possible to make such an agreement, and accordingly you cannot, even if you make such an agreement, actually that you will not get a deduction for this. But actually you can, of course, you can use the revenue. Okay, certain percentage of the revenue you can take as rent, but not the profit. Okay. If an assessee takes premises on lease and agrees to pay arrears of rent to previous tenant, such arrears of rent cannot be allowed as deduction, whether arrears are paid under legal obligation or voluntary. Okay, now I wanted to start my business. Then I have identified the location and identified the building. And when I approach the owner, he says actually, okay, then now I can give this building on rent to you after 2 months or so, since actually already there is one occupant, and he is actually yet to pay maybe 3 years, 3 months rent is due from him. So if you really wanted to start your business immediately, you are saying, okay, I will pay the rent for you. Okay, but if you are paying the rent for you on behalf of the other person, you will not get any deduction on that. Okay. If an assessee takes premises on lease and agrees to pay arrears of rent to previous tenant, such arrears of rent cannot be allowed. Arrears of rent of the previous tenant cannot be allowed. Okay. So arrears of rent to previous tenant cannot be allowed as deduction, whether the arrears are paid under legal obligation or voluntarily. Legal obligation means actually you made an agreement, accordingly you are doing that, or you yourself says, okay, I am ready to pay that amount for you, so that you actually rent out the building to me, like that he is saying. Then whatever be the case, actually it is not allowed. Now if you are okay, now the seats of cinema hall, for example, it is being repaired, damaged seats repaired, it's a revenue expenditure, and the seats, if you increase the capacity, then only it's a capital expenditure, otherwise it's a revenue expenditure only. Now section 31. Section 31 says repairs and insurance of machinery, plants, furniture. All these repairs of plant and machinery and furniture. Okay, and insurance of plant and machinery. All these are allowed as current repairs of machinery, plant and furniture in computing PGBP income. Okay. Now current revenue repairs of the plant and machinery. Now, if it is by the owner or tenant, repairs include renewal or renovation, but exclude replacement or reconstruction. You cannot replace the plant and machinery, okay, or furniture, but you can renew it. Okay, you can do the renovation. Then it is allowable for the tenant or owner. Deduction allowed only for current repairs and not for arrears of repairs of earlier years. You are not, just like the former case, actually you are not allowed any arrears. This can be claimed under, but actually in this case actually this arrears can be claimed under 37(1). 37(1) means actually which are not covered under section 30 to 36 left out items are covered in 37.1. Therefore, you can claim it under 37.1. Current capital repairs. So only revenue repairs are allowed. Capital repairs are not allowed. Capital repairs of the furniture and plant machinery is not allowed under PGBP. Insurance or premium by the owner. The insurance must be against the risk and damage or destruction of machinery, plant and furniture. The owner of the P&M, he can take insurance against the risk or damage or destruction of the machinery. The asset must be used for the business of the assessee during the previous year at least for 1 day. So whenever you take insurance, at least for 1 day, that asset must be used as a business during the previous year. Third point is premium should have been actually paid or payable under the mercantile system of accounting. Okay, so 43B is applicable here. So premium should have been actually paid. Okay, and in the accrual method of accounting or mercantile system of accounting, premium should have been actually paid or payable. Premium you should have paid, actually paid. It is not accrued. The premium can be in the form of contribution to trade association by which the members are insured against losses. To claim deduction, the asset must have been used actively or passively for business purpose of the assessee at least for 1 day during the previous year. So you have to use it actively or passively. Okay, in the business. For example, some item, for example, you consider for fire extinguisher. Fire extinguisher is not required to be used in the whole year. But even then, deductions is allowed to that asset. Okay. So you cannot argue that actually, okay, I mean, you are not actively use it as a passive use and all. You cannot say it because actually only in case of fire is there, the only fire extinguisher is used, otherwise is not used. So that does not deny the deduction. Insurance and repair charges of asset owned by assessee but not used for business during the previous year would not be allowed deduction. Okay, the repair charges should be for the business, should be for the assets used for business. Deduction of full amount of expenses on repair and insurance charges are allowed even when used for part of the previous year. It is not required that the whole year it should be actively used. Even for it is used for part of the year, for the previous year, even then actually the deduction is allowed in full. Now let us consider one example. Imagine a business owner, Mr. Sharma, who owns a textile manufacturing company. He uses various machines for the production of textiles. During the financial year, one of the machines breaks down and requires immediate repair to continue production. Mr. Sharma pays 50,000 rupees for this repairs. Additionally, he has taken an insurance policy for all the machinery and pays an annual premium of 20,000 to cover any unforeseen damages or destruction. Under Section 31, the Income Tax Act 1961, when Mr. Sharma filed the income tax return, he can claim the following deductions. Rupees 50,000 he paid for the current repairs of the machinery, as it is a revenue expenditure incurred during the year to maintain the machinery. Now rupees 20,000 actually he paid as annual premium for insuring the machinery against risk and damages and destruction. However, Mr. Sharma decided to upgrade the machine to more advanced model. The expenses incurred would be considered capital expenditure and would not be deductible under this section. As we said, the capital expenditure for repair of plant and machinery or furniture is not allowed. Okay. Now we have covered section 30 and 31 here. Two small sections we have covered here. Now the next section that is coming is section 32. That is the depreciation on capital assets, and this is a very lengthy section and a little bit complicated compared with the previous section 30 and 31. Okay, and claiming depreciation is mandatory. Everybody has to claim the depreciation. Depreciation is mandatory. You cannot say I will not claim depreciation this year and whenever I feel like claiming I will claim it. It is because if you're doing like that, the problem is that your WDV, written down value, will be different for different people. That's also there. For example, this year, in this previous year, your income or profit is only 1 lakh. Okay, so up to 7 lakhs with the various savings and all, you are not liable to pay tax. That if you claim depreciation or not, your profit is below the taxable limit. So you are thinking that, okay, this year I am not going to claim depreciation. Then after next year, or maybe in the year where my profit is high, I can get some deduction through depreciation. So that way you are misusing the provision of depreciation. So even, okay, you have the freedom to claim or not claim the depreciation, but your WDV to be deducted each year. Even if you are claiming your depreciation after 2 years, this then what will happen? For the previous 2 years depreciation also to be deducted from the cost of the asset, then WDV will be calculated. On that WDV only you can calculate the depreciation. You cannot calculate depreciation on the cost of the asset. Okay, this year you purchase some asset and you are not claiming depreciation this year, next year also you are not claiming, and the third year you are going to claim it. That means actually in the third year you cannot consider your WDV as the cost of asset because you are not claiming depreciation. Okay, WDV or written down value is actually the cost of your asset minus the depreciation claimed. So even when you are not claimed depreciation, whenever you are claiming depreciation, you have to deduct the depreciation for the previous years also. Then you have to arrive at the WDV on which you will calculate depreciation. So actually it is mandatory to calculate WDV based on your depreciation. Okay. Now depreciation on is chargeable on assets. Asset can be tangible asset. You know what is a tangible asset. In lower class you have learned what is a tangible asset. Okay, which can be touched or seen, whatever. Okay, that is a tangible assets. And intangible assets actually, you know that how patent, copyright, trademark, all these kind of things are intangible assets. So Income Tax Act has defined what are the tangible assets and intangible assets on which depreciation can be claimed, allowed, depreciation allowed. Okay, depreciation allowance is given only on these items: tangible assets, buildings. Okay, first class. There's different classes are there. The class 1 buildings to furniture and fittings, and plant and machinery and ships. And part B, this is actually intangible assets will come. Okay, when you say furnitures and fittings mean electrical fittings. Electrical fittings does not include the electrical equipment, fan, other things and all, fan, motor, and that will not come under fitting. Fittings means that electrical fittings in the wiring and other things will come. In the switches and wiring will come in the fittings. Okay, so furniture and fittings, then buildings. Okay, buildings can be different classifications are there that we will come to all these things. What are the things? Now you can claim depreciation on buildings, furniture and fittings, plant and machinery, and ships include some other things also. Okay, ships. Okay, for tangible assets and intangible assets, these are the things. Know-how, patent and all, but know-how, patent, copyright, trademarks and all. But actually, goodwill is not included in that. Goodwill is excluded from this. Okay, so goodwill is not considered. Yeah, but it was for up to 2019 it was there, but from 1/4/2020 goodwill is removed from the list. Now depreciation can be, the WDV method and SLM method. In for depreciation calculation of income tax, SLM method is allowed only to power sector undertakings. Okay, they have the freedom to choose SLM method or WDV method, but all other businesses should choose WDV method only. Okay, so when you opt for SLM method, the power sector undertaking, they have the accounts actually will be on individual asset basis. But here WDV method, it should be block of asset. What is the block of asset? Block of asset means actually same class, same rate of depreciation. Same class, same rate for building. for example, building class we are taking. Under the maybe there may be 10 percentage, 5 percentage, like that it may be there. Okay. So in that case, you have to consider based upon this all 10 percentage buildings will consider as a block. Like that it will go. Okay. Like that P&M also. P&M now also will be different. Blocks will be there. That you will learn all these things in the coming portions. Okay. So for claiming depreciation, one shall be the owner of the asset. Then only he can claim depreciation. Something is not his own, or he is the owner of the asset. How can he claim the depreciation? It's not possible. So he shall be the owner wholly or partly. He can be partial owner also, or fully he can own the asset. Okay, and that should be used in his business or profession in the previous year. Okay, he is the owner, but he is not using it for business profession or profession. He is using it for his personal use. Then he cannot claim depreciation on that. Okay, for example, a generator is bought by a person in the name of the business. For the business he purchased a generator, but he used the generator in his home for his personal use. Or a motor is purchased and is used for his personal use. These are not, and for this such a depreciation cannot be allowed. Okay. Now it can be, as I said, it can be a partial ownership also. And some asset of 1 crore, X and Y Limited, X Limited and Y Limited jointly bought that asset in the ratio 60-40. If the depreciation block is 15%, then actually that only 60% of the depreciation, means 1 crore and 15% depreciation is there. You have to multiply it with that. You will get the depreciation and the WDV is actually, okay, if you are considering as 1 crore, then you have to multiply 15% and only 60% X Limited will get depreciation and the balance will go to Y Limited. Okay. Now, depreciation to be claimed, you should belong to the eligible class of assets. Eligible class, what is the eligible class? We told there are 4 classes actually, that buildings, then we told in the beginning, so that's what we discussed. These are the eligible classes. What are the eligible classes? Okay, eligible classes actually, furniture and fittings, okay, then buildings, then P&M, and then intangible assets, then ships. All these things are all these items are all the eligible class of assets. No other class will get depreciation. Only these classes will get the depreciation. Okay. Tangible assets, already we have discussed the things. Okay. Now there is from previous year 1920 onwards, goodwill is not considered as a tangible asset. Before that, it was considered tangible asset. Then from previous year 2021 onwards, it is removed with effect from 2021. Now, if you have a WDV, then the format for calculating WDV is actually opening WDV is there. Okay, then you have to add the cost of the asset that you have acquired during the PY. If you bought new asset, you can add the item to that. Then actually some sales you have done, some of the asset is sold, you can remove it. You have to deduct it from that. Okay. So you can, the WDV, and if some goodwill is also there, because actually I told you from 2021 onwards, goodwill is not there. If that is the case actually, then if goodwill is also included in the block, that can be removed from that. Okay. Then you can find out the WDV, then depreciation can be calculated as per the percentage. Then you can find out the closing WDV for the particular year. Like that you can do. So no other capital asset is eligible for deduction under section 32 PGBP business income. Only those capital asset what we discussed, only those class are only eligible for PGBP depreciation deduction. Now when we talked about building, that does not include the land. Okay, that land is to be, the value of land is to be deducted from that. Land is, for land is actually not depreciable, it is appreciable. Therefore, on land we will not get any depreciation. Then, as per section 43.3, plant includes ships, books, vehicles, scientific apparatus, surgical equipment, if for the purpose of business profession. A lot of things are included, but actually it does not include tea bushes, livestock, buildings, furniture, fittings. Okay. Fittings, actually this is not electrical, it's water and other things. Other fittings. Yeah, that's it. Electrical water. These will not come under plant and machinery. Plant and machinery different. All these things will come. This furniture, we have separate in classes there. Okay, furniture and fittings. It will come under that. Fittings also will come under furniture and fittings. Okay, so this will not come under that. Then animal, human body, stock in trade. Stock in trade is an inventory. For that also, it is not considered as plant. What we are saying is what the definition of plant. Okay, plant does not include buildings, furniture, fittings and all. But plant includes all goods and chattels. Okay, all goods and chattels. So, chattel, what does chattel mean? Possessions, properties and belongings. All tangible assets. Okay, other than freehold land. This, it can come under that. Plant. Fixed or movable, used in business. So all tangible assets used in business can be plant. It can be a part of a plant or machinery also. Okay, but does not include animal, human body, stock in trade. Animal, if you are saying that animal, the question can come actually with, animal is an asset or not. Animal is an asset, no doubt, because if you are using in milk industry, animal is an asset. From that actually they are getting the milk and it is being sold. Okay, but actually animal, when animal is bought, the cost of the animal is there, actual cost. Then actually you cannot depreciate an animal, right? It is not possible. So depreciation is not possible. So what we will do when it is dead, there will be price on the carcass. Means on the dead body of the animal or the carcass, there will be a price, and you will deduct that price from that. Whatever you are getting will be written off from your book of accounts. Okay. So there are buildings are there, the theatre building, hospital building. The hospital buildings are, they have number of equipment in that, but even it cannot be considered as a plant. All this building, theatre building, hospital building, hotel building, everything is considered as a used in business are considered as buildings only, not as plants. Then buildings include roads, bridges, culverts, tube wells, etc. Okay. Now we will consider one or two examples. For getting depreciation, it should be actually used in the business. When used in business it should be put to use in business. What is put to use? Okay, you have purchased some asset, but you are not using it in business, you have not tested it, then you have not installed it, then you are just trial run conducted. But in that case, it is you will not get a depreciation of that. You have to use actively. You have to use it in the business, not actively. Passively also you can use. You have to use in the business. Why I am saying passively? For example, you take the case of fire extinguisher. Fire extinguisher, you have used for a business does not mean actually it should be used actively, because only when there is a fire, the fire extinguisher can be used. No, otherwise it cannot be used. So such cases it can be passively also can be used. And spare parts. Spare parts are there. Spare parts of the asset. Okay, that can be capitalized also, because actually you cannot actively use unless otherwise there is a issue for the machine, there is a fault for the machine, there is a repair for the machine, you cannot use it. Okay. So you can consider a case in the previous 24-25 some asset purchased. Okay. On 10-24 you purchased it, then installed on 12, then trial run conducted 2-1, then put to use, actively used in the business and 4-4, then only depreciation is allowed. For an asset to get depreciation, it should be put to use in the business. Then only it will get it. Okay, now you have done the trial run you conducted, but it failed. Then trial run successful means it is ready for use. But due to some reasons, you are not okay. Now actually trial run conducted. Now there is a power failure for 1 month. There is a power failure. Maybe some cable failed, or maybe COVID came. Okay, so you are ready to use but not used due to forced idleness. So even then depreciation is allowed in that case. Why? Because it is ready for use. Your trial and conducted, everything is done. You installed it, then actually it is ready for use. Okay. You put it on the foundation, you get installed, the trial and conducted is successful. It's ready for use. Therefore, depreciation is allowed in the PY. Now we told there are different class and different blocks are there. What do you mean by this thing? I will just explain this thing to you. Means actually the first class, one class you have taken building class. Okay, the tangible asset, part A tangible asset, you have taken the class buildings. Class building, actually there are different blocks: block 1, block 2, block 3, block 4 as given. So in block 1, it is actually residential buildings other than hotels, boarding, or all other things you remove. Only residential building you remove. Residential building. This is a residential building block. Residential building block, the depreciation only 5%. Okay. Then for non-residential building, can be a garden, shop, office, factory, whatever, hotels and all other things you put together, actually it is 10%. Depreciation is 10%. Because in factory and all, and that more severe condition, you the building is there. Okay, not like residential building and all. It is in residential buildings and all, it is well maintained and all. Factory and all, that may not be there. Therefore, life will come down. Life may come down. That may be the reason. Whenever actually the life is short, actually the depreciation is more. Okay. Now, block 3, water supply project building for plant and machinery, acquired on or after 1/9/2002, it is 40%. Then temporary structures. Temporary structures, the life is very, very short. Okay, temporary structures, you may be a thatched shed, or maybe you used some temporary, maybe cement walls and all, you used cement boards, you used to build some structure. Okay, in such cases and all, you will get 40% depreciation. This is what it is actually. Now, okay, anyway, you come up to this, then we can check the others also. Now, furniture and fitting, the second class fitting, furniture fitting. Furniture fittings, there is actually, then furniture includes electrical fittings also, wiring, switches, sockets and all, it will come there. 10% is allowed depreciation. Now, plant and machinery. Plant and machinery, there can be general plant and machinery. If nothing is mentioned, only plant and machinery, you will take the general plant and machinery, that is actually 15% is the general plant and machinery you have to take. Okay, general plant and machinery, general rate you have to take. Okay, note in other blocks. Okay, maybe some motorcycle fan, oil well. Okay, whatever, it is 15%. Then books for lending libraries are 40% are there. Okay, lending libraries. Books for professional use 40%. Then now that includes maybe some computer, including computer software, means that operating system, Windows, for example, Windows or is the okay in with actually computer with OS, then in that case is 40%. You will get depreciation for computer. The windmills and all, you will get 15%. Okay, now renewable energy, you will get 40% depreciation. Then energy saving devices 40%. Then glass, plastic containers for refilling 40%. Then the plant and machinery for water supply projects acquired on or after 1/9/2002, 40% reduction you will get. Then life-saving medical equipment 40%. Semiconductor industry, the plant and machinery used for semiconductor industry for chips and other things. Okay, ICs and all for that. For the manufacture of semiconductor, we get a depreciation of 30%. Aeroplane and aero engine 40%. Then mold used in rubber and plastic goods and factories 30%. Then again motor cars. Motor cars other than used in business or running them on hire, acquired and put to use between 23/8/19 and 31/3/20. Will give 30%. Okay. Motor cars other than used in business of running them on hire, acquired and put to use 1/4/90. After 1/4/90, it is only 15%. Okay, between 23/8/19 and 31/3/20, it is 30%. We are not motor cars other than used in business of running them in hire. Mean for renting purpose, renting car hiring. If you are hiring, you are using it is more. If you are using business between 23/8/19 and 31/3/20, it is 30%. And after 1/4/90, okay, 1/4/90, you will get 15%. You will get. Okay. Then motor cars, lorries, cars, taxis, business running them on hire. Mean if you are in the business of hiring buses, lorries, cars, taxis and all, then you will get 45% reduction. Okay. This is actually between 23,819 to 31,320. So motor cars, lorries, and in the business of running them higher other than block 3. If it be between 23,819, 31,320 is 45%, and if not coming in that period, you will get 30% reduction. You will get. Okay. So this is how it is going. Now third one is actually ships and all. If you are taking, it is ocean going ships 20%, vessels ordinary operating in inland waters 20%. Ships, all the ships you are getting 20%. Okay. So now for intangible assets, okay, you are getting 25% reduction. Now put to use. What is put to use? When you say put to use, it can be active use or passive use. But if it is ready to use, it can be considered as put to use. Okay. Standby equipment, fire extinguishers, etc. can be capitalized if they are ready for use. Machinery spares, which are part of tangible assets, can be capitalized. Yeah. Suppose actually you have an asset. Okay. And it is actually you are partly used for business, partly for your personal use. For example, you have a car. A car is 60% used for your business, 40% you use for your personal uses. Okay. In that case, how the depreciation is calculated? It should be, because the personal use depreciation will not cannot be given. Business use only depreciation is given. So the depreciation should be only 60% depreciation only you will get for a business. 40% you are using for personal use. Therefore, that you will not get it. It should be proportionate depreciation only you will get. Okay. It is explained in section 38 that you will learn later. Okay. And this should be approved by the assessing officer. Assessing officer of the income tax should approve it. Okay. The way you are using it. This particular asset actually they should approve it. Now depreciation, you will get full depreciation and 50% depreciation. There are two cases are there. 50% depreciation you will get if you are using the particular asset in the year it was purchased for less than 180 days. If you are using it 180 days or more, then you will get full depreciation. For getting full depreciation, you have to use it 180 days or more in the year in which the asset was purchased. Okay. Now 180 days means actually from before 4th October. Okay. Before 4th October, it is 180 because it is 365 days. It is not a leap year. If it's a leap year, 366 days are there. Then 2025 is not a leap year. Therefore, we can consider 365 days only. Then, if you acquired the asset after 3rd October, from 4th October onwards, okay, 4th October means from 4th October to 31st March, it is 179 days. From 1st April to 3rd October, okay, it will be 180 days. Okay. So 4th October to March 31. It is 179 days only. So asset acquired during this period is less than 180 days. So in such cases, in the year of purchase of the asset, if you use that asset or put to use mean always remember use mean put to use. Okay, you are used it in your business. Put to use for less than 180 days, depreciation shall be allowed only 50% of the allowable depreciation of the block. In subsequent years, you will get full depreciation. Next year, you will get full depreciation. But in the year of purchase, if you are if you put to use it for less than 179 or sorry 180 days, then you will get only 50% of the depreciation. Depreciation allowable is 50% of the normal depreciation if the following conditions are satisfied. What are the conditions? Where an asset is acquired during the previous year and it is put to use for less than 180 days during the year. These are the conditions to be satisfied. Now let us consider an example. Let us consider a general block, plant and machinery, in the previous year 24-25. So opening WDV for assets A and B as in 1/4/24 is 1 lakh rupees. And after that, this is the opening WDV. There are two assets are there, A and B. Then the WDV means actually the depreciation is deducted. Okay, depreciation deducted from the cost. Then all depreciation deducted, then you will get the WDV. So it is 1 lakh. Now you have purchased two assets, C and D. Okay, C you have purchased 5/4/24 and put to use that day itself. The cost of the asset is 60,000, and D 10/6/24 you have purchased but put to use 15/10. That means after 3rd October. This is before 3rd October. That means full depreciation you will get. Okay, here actually even though you purchased on 10/6/24, you have put to use it on 15/10/24. That means you will get only half depreciation on this. Now, then you sold A. Okay, in A from A and B you sold A. Case on 30,000. Second case 1,50,000. We'll consider two cases. Now calculate depreciation on 24-25. Okay, 24-25 you have to calculate the depreciation. What is the depreciation of 24-25? Now we know opening WDV is 1 lakh for A and B together. Both cases it is same. Case 1, case 2, both are the same. And purchases is total 60 and 40, 1 lakh. Both cases it is 1 lakh. So open WDV plus purchases you are doing. Now the total is coming 2 lakhs in both cases. Okay. Now second case sales. Sales first case it is 30. The case 1 is 30,000. So you have to add with the opening WDV the purchases and deduct the sales. So sales you have deducted, A you have sold. 30,000 you have deducted here. The balance is 1,70,000. So whatever this is the the WDV for depreciation you are considering. Then depreciation, two cases will come here. Depreciation. Okay, now put to use for less than 180 days, then put to use for greater than 180 days. Okay. When you are calculating depreciation, first you have to calculate the depreciation on the 50% cases, mean whichever assets are used for less than 180 days. Okay, once it is done, then that asset is to be deducted from the total WDV. Then for the balance only you have to calculate the full depreciation. This is how it will be calculated. Now for less than 180 days only one asset is there, that is 40,000 rupees. For the 40,000 rupees, 15% depreciation, general depreciation we are given. 15% is the rate. Of that, 40,000 into 15%, of that only 50% you will get because it is used less than 180 days. So if you calculate, okay, you are multiplying it, you are getting actually 3,000. Both cases it is 3,000 only because 40,000, 50% we have calculated. Now in the second case actually your sales is 1,50,000, therefore here actually the WDV is 50,000 for depreciation. Okay, now less than 180 days used assets you are calculating the depreciation, it is coming 3,000. Now more than 180 days, how you will calculate? This is actually total 1,70,000 minus the asset used for less than 180 days you have to deduct. For the balance amount whatever we are getting, you are to calculate the full depreciation. So 15% you have to find out for that. Now you are getting 19,500. Okay. You are getting the total both together 22,500 depreciation you will get. Okay, this is the depreciation you are getting, and this depreciation to be deducted from the total you will get 1,47,500. Second case, 3,000 you are deducted. Okay, second case is actually 19,500, but yeah, 19,500. Now here what is the case? Here 40,000 is to be deducted from the WDV, 50,000 minus 40,000. The balance you have to calculate 15%. That's only 10,000 is the balance amount. On that 15% full depreciation you calculate, you are getting 1,500. Total depreciation is 4,500. That means from 50,000 you are deducting 4,500, you are getting 45,500. So this is how the depreciation is calculated. Now one more depreciation is coming, actually additional depreciation, that we will learn later. That is also to be deducted, that you will learn later. Now that I have not mentioned here to avoid confusion. 50% depreciable asset to be added to the depreciation calculated on WDV received by deducting 50% depreciable assets from the relevant WDV and applying full depreciation to the balance. Understand? The same thing I told you. Okay, 50% depreciation asset to be added to the full depreciation. First, actually, you have to calculate the 50% depreciation. Then that is to be deducted from the relevant WDV for depreciation, and the balance amount you have to apply the full depreciation. That's how you are calculated. Okay. Here, let us consider another example. Here, 10% depreciation on furniture you can consider. Now, open WDV, two assets A and B, two furniture A and B are there. The total. So we have purchased two more assets. Okay, the opening WDV for two assets A and B is 50,000. We have purchased C and D. Okay, C is put to use for more than 180 days for at cost is 30,000, and D less than 180 days is 20,000. Now we sold A and B for 90,000. Now we are calculating depreciation. Now as we know that opening WDV we know 50,000. Now purchase to be added to that. C and D purchases to be added. This 30 plus 20, 50,000 added to that. Total 1 lakh we are getting. Now less sales. Sales is 90,000. Now we are getting 10,000. The WDV relevant for depreciation is 10,000. On this 10,000 we have to calculate the depreciation. For calculating the depreciation, what you will do? We have to first actually calculate the depreciation for the 50% case, means less than 180 days use. So there is only one case is there, D. For D, less than 180 days, D, how we will calculate actually for this this relevant depreciation 10,000 only we can calculate. So we cannot calculate take the 20,000 cost of the thing here because actually WDV is only 10,000. So we cannot go for 20,000 also. So the WDV is less than the purchase value. Therefore, what we will do, we will take only 10,000 we will take, and 50% of the 10,000 mean only 10,000 is relevant here. 20,000 we cannot take. It is more than the WDV. Therefore, we will take only 10,000. 10,000 and 10%, 50% also we take because we used only for one or less than 180 days. So it is only 500 rupees. Though this is the depreciation we can calculate only 500 rupees, and this is the WDV. Okay, for the particular year. So depreciation will be allowed to the owner even when the asset is actually utilized by lessee or licensee. Okay, and the asset may be used by lessee or maybe licensee. Okay, even then the depreciation will be allowed to the owner. Where letting out such assets are the business of the assessee or owner, he is entitled for depreciation under section 32. Okay, letting out assets are the business of the assessee or owner. Okay, and he is entitled for depreciation under section 32. The owner is entitled for depreciation. If letting out asset is not the business of the assessee or owner, still depreciation would be available as per section 57(2). Okay, income from other sources. House property let out to tenant for smooth running of the business. Okay, now house property income is there. It is let out to the tenant for smooth running of the business. If an assessee lets out a property to his employee for smooth running of his business, the rent received from employee will be PGBP income, and such property is eligible for depreciation under section 32. Now, normal case actually, even when letting out house is a business, then the income is considered under the head house property. But if it is essential for the smooth running of the business, then it can be considered as PGBP income. You are actually given on rent a house to your employee, and it is essential for the smooth running of the business. Then it is a PGBP income, and you can claim depreciation on that. Now, if you have rented out your property or building for some government agency, maybe some police station, bank, post office, tax office, railway staff quarters, etc., then the rent you are getting out of this will be a PGBP income, and you can charge depreciation on that. For example, you have a big factory complex. In that, actually, maybe in the factory, maybe 5,000 workers are working, or 2,000 workers are working, for example. So you need a bank inside that. So the bank is required, or a post office required. So you are letting out one building to the government agency for starting a bank, or for commencing bank, or a post office there. Then such kind of income what you are getting is a business income. So it can be considered as a PGBP income, and you can charge depreciation on the building also. Now, for example, another case you can consider, you bought some asset, okay, on 6th June 24, but you put to use it on 31/3/25. Only one day you used it, you put to use it. Even then, you can get here. Actually, you can get only 50% in the same year. But next year, if you put to use on the next year, means actually after 1/4 or 1/4 itself, you are using it on maybe 20th 4/25. That means next year. So you will get full depreciation even though you used it one day. Maybe the end of, okay, now the end of 25 mean you are using it, you purchased in the previous year 24/25, but you put to use the next previous year only one day used, maybe 31/3/26 you have used it. Okay, in that case you will get full depreciation on that. Even if you are using it for one day, you can claim full depreciation. In the same year of purchase, if you are using only one day, you will get, it is less than 180 days, you will get 50%. But next year, if you are using only one day, you are using it, then you can claim full depreciation. Put to use should be commercially put to use. It's not a trial run or something. It should be commercially put to use for the business. When a machine is kept ready after trial run and all, it is kept ready. Okay, you kept at standby or something. It's a spare machine. Or in such cases also you can claim depreciation. You are entitled for depreciation. If put to use in a different previous year other than the previous year in which purchased, full rate of depreciation is claimable, irrespective of the number of days used. First year of put to use, used greater than or equal to 180 days, okay, mean 1st April to 3rd October. You can claim full rate of depreciation. Used for less than 180 days, from 4th October to March 31st, you can claim 50% depreciation in the year of purchase. Actually, in the year, both cases are applicable in the year of purchase. Okay. Second year, yeah. Second year, your first year actually, second year also you will get the full rate, even if used for only one day in the previous year. Okay. And here, less than 180 days, you will get the full depreciation in the second year. Both cases you will get the full depreciation. The assessee must own the asset partly or wholly to be eligible for depreciation of the asset. Now, lesser can be considered as owner. Lesser is owner. Okay. And there's a lessee and lesser is there. Okay. Lessee is giving the asset to the, lesser is giving the asset to the lessee. Then lessee is giving him the rent. Then depreciation is allowed to the lesser. Okay. In case of lease. Lease, we know there are two kinds of lease, operating lease and financial lease is there. Okay. And lesser is the owner. So he will get the depreciation. No depreciation will be allowed to an assessee who does not own the asset but only uses or hires the asset for business. Okay. So he only use it. He just actually hires it. Then he will not get the depreciation. The owner will get the depreciation. In case of buildings, assessee must own the superstructure and should own the land or be a lessee of the land, and lease deed must provide that the building will belong to the lessor of the land upon the expiry of the period of lease. Okay. So if the conditions is like that, upon the expiry of the period of lease, it will be owned by the lessee. In such cases, he may be able to claim the depreciation. He is the deemed owner. Explanation. Where business or profession is carried out in leased building or other rights of occupancy, the capital expenditure incurred by the assessee for the purpose of business or profession or construction of any other structure, renovation, extension, improvement to the building, then depreciation is allowed to the deemed owner. If it's a long lease or something, okay, and maybe 30 years he has taken the building on lease or land on lease, then actually in that, for his business purpose, he has to do some expenses, capital expenses that he has to make. Then actually he can claim depreciation on that. It's a deemed owner. Then depreciation is allowed as a deemed owner. The capital expenditure on a property by the lessee is allowed if done for his business or profession. And this is explained in AS 19 also. The depreciation will be allowed for assets wholly or partly in respect of assets used for business or profession. Okay. So depreciation is allowed wholly or partly based upon the business use. Okay. I mean, if he is using 50% for the business, he will get 50% depreciation. Even if the assessee is not a registered owner, if he is a beneficial owner, he can claim depreciation. That meaning, if he has the full control of the asset, he can claim depreciation. If it is joint ownership, depreciation is allowed on proportional basis, as we told. A and B together owns an asset, and based upon their share in the their investment in the asset, on the asset, actually they can claim depreciation. Now there are two cases: hire purchases. Then we talked about financial lease also. Financial lease, what will happen? No, mean actually at the end, the lessee can get the asset for a small amount, because actually that almost all the cost of the amount might have been taken by the lessor. Then at the end, actually the asset will be handed over to him. In hire purchase, it's a different case. Hire purchase, what happens is the buyer is considered as an owner, and it will be handed over to him. The ownership will be given to him when the last installment is paid. So it is almost the same only. In case of property acquired on hire purchase, the buyer can claim depreciation even though he does not get legal title of the asset till he pays the last installment, as he gets substantial rights whenever contract is made. So the buyer can claim depreciation because actually he gets substantial rights whenever contract is made. Now, Section 53 of the Transfer of Property Act, possessor of an immovable property under Section 53A of Transfer of Property Act can claim depreciation, even though he is not registered owner of the property. Okay. Now you consider case 1, in which actually asset is there, depreciation 15%. Okay. Then it is business use and other use. 20% business use, 80% other use. So if he is using 20%, then 20% share of the depreciation he will get. Of the total 15% depreciation on the opening WDB, he can claim that. 80% somebody is using, some other business is using, he will get 80% share. For example, one asset is there, depreciation 15%, 1 crore, it is used more than 179 days. Then owner 1 and owner 2, 50% share is there. Then owner 1 will get actually 50% of 15%. That is 7.5 lakhs. The other person will get 7.5 lakhs. This is how it is divided. In case of financial lease, depreciation is available to the lessor. Lessor is the owner. Okay, not to the lessee. Lessee will be transferred, mean that the asset will be transferred to the lessee at the at the end of the lease period, maybe then maybe for a small amount, maybe that small amount is to be paid. Then he can take the asset in his name. But actually, the depreciation will be allowed to the lesser in that case. But in case of hire purchase, to the buyer it is allowed. In case of hire purchase, depreciation will be available to the hire purchaser as he gets substantial ownership rights at the time when contract is made. Depreciation can be claimed only on put to use. From the date of put to use only depreciation can be claimed. So when purchased 10/10/24, then installed in 12, trial run 31/2, put to use in 23/5, okay, then depreciation can be claimed only then. Till that time depreciation cannot be claimed. This is the same thing what we told. Hire purchase is there, is an asset, then hire purchase vendor is there, then hire purchaser hirer is there. Okay, this is the vendor. Then hire purchaser hirer, he is considered as the owner. The depreciation allowed to him. Okay, multiple small payment of assets. Okay. Now here actually we are discussing the method of computing depreciation allowances. How we are going to compute the depreciation allowances. So before going into the detail, we have to define certain terms. We should have clear understanding of what is block of assets, what is the actual cost, what is written down value. Now, written down value, we know it is the cost minus depreciation. So if it is the cost is under depreciation percentage 10%, then the double DV will be 100 minus 10% into 100, it is equal to 90. And the second year, from that 90, you have to deduct the depreciation, 90 into 10% you will deduct, and you will get 81 and so on. SLM method, the depreciation will be the same during the life of the asset. There is actually actual cost into 10%. For the life of the asset, that will be the same. Depreciation will be the same, that will not change. Now, actual cost is actually the net cost, means the cost minus the cost for acquiring the asset. Now let us see what is block of asset. Now we know that we have the asset as per Income Tax Act can be classified into buildings, furniture and fittings, plant and machinery and all. So when we talk about building, we will consider only the superstructure. Land is not considered part of the building. And if land and building are purchased together, then the fair market value of the building is to be calculated separately, on which only we will get the depreciation. Then plant and machinery means actually that any equipment, fan, light, computer or maybe machinery, everything will come under plant and machinery. Then furniture and fittings means furniture is a movable item, and whereas fixture is actually fixed, that cannot be moved. Just like maybe chairs in cinema hall, maybe a bench in a park, cement bench in a park, or cupboards on the wall. All these are actually fixtures. And electrical fittings are electrical fittings, wiring, switchboards and all. Then we know what is intangible asset. We already discussed all these things. Now, assets are categorized into class. Then each class is divided into different blocks. We already seen all these things. Then we know the block of assets, which is what is the block of assets? Is a group of assets falling within a class of assets comprising of tangible assets of building, machinery, plants, or furniture, or maybe it can be intangible assets also. Know-how, patents, copyright, and all. Now we have already seen what are the categories, or maybe what are the blocks in each class: building class, furniture and fittings, plant and machinery, and all that we have already seen. Now let us see. Building, we have just now mentioned that building means only the superstructure, and land will not include in that, and it includes roads, bridges, wells and tube wells. Everything will be included in buildings. Building, when we talk about a building, it is considered, because building there are different classes out there. If it is a building that is used for residential purpose, the percentage depreciation is 5%, and if for other purposes it's 10%, and it's a temporary structure, it is 40%, like that it will go. So if 2/3 of the building, 2/3 of the area, built-up area or floor area is used for residential purpose, then it is a residential building. Now you consider a building is a 3-story building. 2 floors are used for residential purpose, and 1 floor is used for office purpose. Then it is 2/3 is used for residential purpose, then the depreciation will be 5%. Now another building, 2 floors is there, 1 floor for office, 1 floor for residential purpose, then it will not satisfy the criteria of 2/3. 2/3 means it is 6.6%, 6-7%. Now it is only 50%. Therefore, it will come under category 10% depreciation. Now we consider 4-story building, 3 stories are used for residential, 1 floor for office purpose. Then again it is a residential purpose building, 5% depreciation is applicable here. Now the cost of wooden doors, windows, etc. This is not considered as furniture, it is part of the building. Now we have already discussed that plant means ships, vehicles, books, scientific apparatus, surgical equipment, everything will coming under plants. Okay. Now tree bushes, livestock, etc. are not considered as plants and machinery. Why? Because actually there is a reason. We have already discussed that livestock will not get depreciated, but on its death, the dead body or the carcass will be charged to P&L as expense at its original cost minus amount realized on carcasses, and hence no depreciation is allowed. So you will get an amount actually that whatever cost you can earn on the dead body of the animal, okay, that you can take, and that cost will be deducted, and balance amount you can charge to P&L. Okay, now for tree bushes, cost of planning, labor, maintenance, etc. are charged to P&L, and revenue expenditure each year, and even as revenue expenditure, and even there is an asset, no depreciation allowed on that. Now there is another block, P&L general, which is usually used for for actually that any other plant and machinery not considered in the other blocks. Okay. Now that motor car, motorcycle, everything will come under this. There is no specific depreciation rate for these things. Therefore, road roller, tractor, everything will come under this. Now, computer software means a computer program recorded on any disk, tape, etc. And its depreciation is 40%, as we know. Now, depreciation is mandatorily available, so the assessee cannot say that I will not claim the depreciation. Now, if charging depreciation is optional, whenever there is taxable profit, then depreciation can be used as a tool to reduce profit and to pay less tax. Okay, this year I am not charging depreciation, and whenever I get profit, I will use the depreciation to reduce my tax, and that is not the fair practice. Whether you charge it in P&L or not, for calculating your profit, depreciation is to be deducted for each year mandatorily to calculate the open double debit for the accounting year. Now, you cannot give more than 10,000 rupees in cash to buy an asset. If you pay more than 10,000 rupees, you will not get depreciation for that. So you have to pay through bank, at least by account-based checks or through net banking and all. You have to pay, or the eligible transaction you have to do. Then only you will get depreciation. If you buy some item by giving cash 20,000 and account-based check for 30,000, you will get depreciation only for this 30,000. For the 20,000 cash paid, you will not get any depreciation. Now we have mentioned earlier that power transmission companies, distribution and generation companies can use SLM method of depreciation. They can opt SLM method or WDB method. And power companies can exercise the option of being allowed depreciation on SLM, depreciation charge on individual asset basis. But then that should be individual asset basis. That will not be on block basis. WDB, like other assets, if they are opting, then they can go for block of assets basis. They can do the depreciation. Now, this SLM or WDB method option by partial undertaking, that must be exercised before the due date of furnishing return under section 139(1) for the assessment year relevant to the previous year in which it begins to generate power. So they have to use this option before 31st of October. Okay, because actually it's a company where auditing is there for companies where auditing is mandatory, or for firms where auditing is mandatory, the last date of furnishing return is 31st October. Otherwise, no auditing required, then it will be 31st July. So, option once exercised, exercise shall not be reversed and shall be final. Once you opted for SLM, then you have to use the SLM. This is to be done actually before generation begins, power generation begins. Then there is additional depreciation is not allowed to assessee who claims depreciation as per SLM. If you are claiming depreciation as per SLM basis, you will not get any additional depreciation. We will learn about additional depreciation. It is a depreciation of 20% we will get additionally to the normal depreciation. Okay. So such cases, if you are opting for SLM method, this method can be used only by power generation companies. If a power generation company is opting for SLM method, they cannot claim additional depreciation. The format to be followed in case of block of asset WDB method, as per section 43(6)(c), is as given here. Now, first is actually the opening WDB of the block you have to give, then you have to add the actual cost of asset acquired. If you have acquired any assets during the previous year, that is to be added, and put to use less than 180 days and more than 180 days. Both you have to separately added. Okay. Then again, you have acquired some asset but not put to use. Those assets to be, you have to deduct. Okay. Then assets sold during the previous, that is also to be deducted. Then WDB of assets transferred in slump sale. Slump sale you will learn in capital gain section 50. You will learn all these things. What is the slump sale and all. WDB of the block of depreciation at the end of the year you can calculate. Then you have to deduct the depreciation. Okay, for the current year. Then you will get the closing depreciation. Sorry, closing WDB you will get. See, slump sale is actually for income tax purpose. It's one where the undertaking is sold without considering the individual values of the assets or liabilities contained within the undertaking. It's a lump sum value. Like, it may be important to note here that finding out individual values may be of relevance only for the purpose of determining stamp duty or other similar taxes. In simple words, slump sale is nothing but transfer of a whole or part of the business concern as a going concern. Okay, it means the transfer of one or more undertaking as a result of the sale of a lump sum consideration without values being assigned to the individual assets and liabilities of such sales. Okay, in order to consider slump sale, in order to consider it as a slump sale, the business is sold off as a whole and as a going concern. It is not sold part by part or something like that, and it's maybe some lump sum value it is being sold. Then materials available on record do not indicate item-based value of the asset transferred. Okay, we're saying actually this is a lump sum value for the whole company or firm or whatever it is, and this is what you have to pay. Okay, that is what is called a slump sale. Now let us consider 32(1)(2)(a). Okay, that is 32(1)(1) and 3(2), everything is there. Now let us first consider 32(1)(2)(a). This is actually additional depreciation. We have mentioned about additional depreciation. Now we will discuss in detail about what is additional depreciation and all. For additional depreciation to be allowed, you have to shift out of the default regime under section 150 BAC 1A. Only for all regime it is available. So if you want to get additional depreciation, two conditions. First thing we told is actually if you are a power sector undertaking and you are following SLM method, you will not get the additional depreciation. Second thing, actually you have to shift out of the default tax regime. You have to go for the old regime. Then only you will get additional depreciation. Only for, and again, second thing, this additional depreciation is available only for manufacturing, production sector, then power sector, then printing and publishing industry. Only these industries it is available. This is mainly manufacturing sector and all. This additional depreciation is given to promote the internal production. Okay, this is what government wanted. We have to just like actually make in India like thing, because we have to. I mean, so inside India or within India, production is to be increased. Then there will be more job opportunities will come, and actually people will. The income level will increase. Like that, actually, government wanted to increase the production, and the per capita income will increase, and for all these things, actually, government is encouraging for increasing the manufacturing or production. So that actually they are given some additional depreciation benefits. Okay, it is actually 20%. The additional depreciation for manufacturing, then power sector, and printing and publishing industry, given 20% additional depreciation. This is a one-time depreciation. You will get only once. That will be calculated on the actual cost. This 20% will be given on actual cost, not on WDV. If put to use less than 180 days, only 10% you will get. But you can claim it. The balance 10% you can claim in the subsequent years. That means up to 3rd October, you will get 20%. That means more than 180 days you are using it. 3rd October means more than 180 days you are using it, you will get 20%. Then from 4th October onward, that means less than 180 days, you will get only 10%. But the balance 10% you can claim in the subsequent previous year. In addition to the normal depreciation, you will get additional depreciation 20% on the actual cost. Okay, under section 32(1), we are getting it is a normal depreciation. Acquired and installed, okay. Acquired and installed on or after 31/3/2005, you get the normal depreciation. But in case the assessee exercises the option of shifting out of the default tax regime under section 115 BSc 1A and pay tax as per optional tax regime, okay, additional depreciation on any new machinery or plant at 20% of actual cost of such machinery or plant, except ships and aircraft. Ships and aircraft, you will not get the additional depreciation, and it should be a new machinery. You will not get additional depreciation on second-hand machines. PGBP assessees are of 3 types. We know: trading, manufacturing, and service. 3 types we have actually. Somebody will be doing some trading, okay, and buying some material and selling. Then there will be manufacturing industry, production industries there. Then there is service industries there. 3 types of assessees are there. But this is allowed only to the manufacturing. This additional depreciation is allowed only to the manufacturing or production industries, and power sector undertaking, and for printing and publishing industry. And only if the power sector undertaking means they have to follow WDV method. If they follow SLM method, this additional depreciation is not allowed to them. Now, this is printing and publishing industry by circular number 15/2016. Okay, dated 19/5/16. It is allowed to printing industry also, and it is also considered manufacturing production industry. Now, the assessee must be engaged in the manufacturing production of any article or thing, maybe priority sector or non-priority sector. Okay, non-priority sector means liquor, cigarette, such kind of industries are non-priority sector. Both priority sector and non-priority sector will get this depreciation as per the 11th schedule. It is available. It is actually given to both priority and non-priority sector. This additional depreciation is available to both sectors. Now, new P&M must be acquired and installed during the period. Then only you will get it. Okay, you will get it on new machines, not on second-hand machines. Now, it should be on eligible plant and machinery. That means the plant and machinery used for manufacturing. Now, for example, actually, you are using AC. Okay, you have a manufacturing industry. The office of the manufacturing industry, you have used some AC. And that is not for the manufacturing purpose. So, for that, you will not get into depreciation. But you are using a lot of electronic equipments inside the factory. For that, AC is required because the temperature is to be kept at a low level. If you are using AC for that, you will get depreciation because that is used for manufacturing processes. Therefore, you will get depreciation there. Now, we have already discussed that asset put to use for less than 180 days. Put to use for less than 180 days. During the previous year, the asset was acquired. Then that means actually from 3rd October to 31st March of the previous year. That means less than 180 days. If that is the case, in the year of purchase, if it is used less than 180 days, then you will get only 10% of the additional depreciation, because 20% is the additional, one time additional depreciation. Of that, you will get only 50%. That 10% you will get. Okay, in that previous year, in which it was acquired. The balance 10% you will get the immediately following or succeeding previous year. But one condition is that you have to opt out of the default tax regime. Then only you will get in the next year. I mean, in the subsequent year also, you have to opt out of the default tax regime. Now there is a negative list for additional depreciation which is not qualified. Ships and aircrafts are not qualified. Okay. Now any plant and machinery used either within or outside India before installation, second-hand plant and machinery is excluded. It should be new plant and machinery. For second-hand plant and machinery which are used within India or outside India is not allowed. Now, plant and machinery which is installed in the office premises, okay, or residential buildings or residential accommodation of the firm, of the organization, or in any guest house. Okay, there is a guest house for the organization, and for that actually that firm you are using, or that company of the company guest house you are installing, or the residential accommodation or the staff you are installing, okay, or the office premises you are installing, you will not get any depreciation. It should be for manufacturing purpose. Any office appliances or raw transport vehicle, okay, you will not get actually a computer used inside the office premises, but you will get if you are used inside the factory for the manufacturing process. Or raw transport vehicle also you will not get, but it is outside the factory, okay, outside the manufacturing premises. Therefore, that's why you will not get depreciation on that. Additional depreciation. Any machinery or plant, the whole of the actual cost of which is allowed as deduction, that is 100% deduction on capital by way of depreciation or otherwise in computing income under PGBP or any one PY. If you have already got depreciation or allowed depreciation, 100% depreciation is allowed, then already such assets actually you will not get any additional depreciation, because in that case already 100% depreciation received, and then you given more depreciation. I mean, you will getting 120% depreciation, so that is not correct. Therefore, you will not get any additional depreciation on that, for which you already taken benefit of 100% deduction. Now, notes. In this, additional depreciation is allowed for plant and machinery and not on assets like furniture, buildings and all. You will not get any depreciation for assets like furniture, buildings and all. For plant and machinery used for manufacturing, you will get. Now, some areas, notified areas are there of Telangana, Bihar, West Bengal, or some backward areas are there. They're actually from 1/4/2015 to 31/3/20. You have it is announced depreciation of 35%, additional depreciation of 35% for manufacturing sector. But after 31/3/2020, the right is reduced to 20%. For other areas, it will be 20% only. Now, additional depreciation shall be reduced while computing closing WDP. Now we told actually we will be deducting the depreciation, okay, while computing the closing WDP. But actually we have to deduct the additional depreciation also. Earlier when we discussed about this thing, we have not mentioned the additional depreciation, since we have not learned about this additional depreciation. You will see how it will be computed. So consider a manufacturing company where actually that P&M block is 15% general. Okay, the open WDV for two assets or machines, A and B, maybe 1 lakh. Then you purchase a new machine C for 5 lakhs. Then what actually some eligible new machine. The C is actually some eligible machine that for manufacturing sector only this is purchased. Then you sold A for some amount. So the total is actually the open WDV, you added the purchase, then it will be 6 lakhs, then sale you are deducted, then the WDV relevant for depreciation is 50,000. From the 6 lakhs you are deducted this 5 lakhs 50,000. Now normal depreciation is there, okay, then additional depreciation also there. Now we know that it is 50,000 only, So we consider this more than 180 days because the dates are not given. So we will consider this is a full depreciation it is getting. So the normal depreciation more than 180 days we will consider. Okay, we'll see we shall assume it is more than 180 days. Then the depreciation we have calculated. Then 15% depreciation 7,500 we have deducted. Then we have to deduct additional depreciation 20% on actual cost of 5 lakhs, not on WDV. This actual, the additional depreciation is always on actual cost of C. Okay, actual cost is actually 5 lakhs, not on, because for new machines only you will get additional depreciation. The additional depreciation you will get a new machine purchased during the previous year, and you have purchased a new machine for 5 lakhs, and the actual cost is 5 lakhs, and you will get additional depreciation of 20% of the actual cost. You will get 1 lakh. That you have to deduct from that. That means actually only 7,500. I mean only 50,000 is there, but 1,07,500 is the deduction. That means the open WDV for next year is nil, because WDV. Okay, WDV is actually actual deduction is more. Deduction is more. Then WDV will be nil. Okay. Then actually. Okay. Now this is wrong actually. WDV is more than deduction is not correct actually. That deduction is more than WDV. It should be like that. Okay. Now P&L account, profit and loss account. Okay. When you be calculating your PGBP income, then the deduction will be when in the PGBP income. But here, even though the open WDV next year will be nil, but in the PGBP income you have to cost. The deductions you can see normal depreciation 7,500, and actual depreciation 1 lakh. You have to show 1,07,500 as your depreciation in the P&L account. You have to show that. Okay, you will be showing that much amount in the P&L account. Now let us consider the problem. Here, let us consider 3 plants A, B, and C. Okay, 3 plants A, B, and C we are considering. All this actually the depreciated value of the block of assets. All these plants are in the same block. So the depreciated value on 1/4/24 is 14,80,000. Okay. Now what happens? You bought an additional plant D on 1/9/24 and put to use on 8/9/24. That means actually more than 180 days it is used. More than 180 days it's used. That means it will get a full depreciation. Okay. So the cost of D is 1,60,000. Now one more plant E you purchased in 24/12. That means after 3rd October. That means less than 180 days. So you will get only 50% depreciation on this. So the cost is 3,10,000. Now there's as you know, there's a sale proceeds. You sold plant A on 3/3/24. Okay, and which is originally purchased on 1 lakh. This is immaterial. Don't consider that. Okay, this is for confusing you. It is given. Now it is sold for 16,30,000 given. It is sold for that, and let the depreciation percentage is 15%. Find out the admissible depreciation. Okay, and if any capital gain is there, we have to assess that for 25-26 assessment year. Okay, assessment year 25-26. That is previous year 24-25. Okay. Now let us see the answer. Here what happens? We have to find the WDV for the block. So WDV for the block is given us 14,80,000. Now we have to add the purchases. 2 purchases that are D and E. One is for 1,60,000 and this is for 3,10,000. Together 4,70,000. Total is 19,50,000. But plant D is used more than 180 days, whereas plant E is used less than 180 days. We already seen here. Okay, so plant D we used actually more than 180 days, and plant E less than 180 days. It is used 24/12. Okay, it is put to use. Now from that you have received the block. For the total block 9,50,000 we have seen. Okay, the WDV of that actually now you have to deduct the sale value of A. We are reducing, we will get 3,20,000 as the WDV related to to calculation of depreciation. Okay, that is 3,20,000. Now here what happened, the sale proceed is less than the block. We have to consider the whole block. In that actually the block WDV is 19,50,000, the sale proceed is less than that. Okay, since it is actually less than, the capital gain will come when the sale is more than the WDV value, then only capital gain will come into picture. Now it is less than that, there will not be any capital gain. Okay, now normal depreciation, we can calculate. Now this is the WDV related to depreciation. Okay, admissible to depreciation. Now let us calculate normal depreciation and additional depreciation. So additional depreciation is on actual cost, whereas normal depreciation on the WDV. So plant D is used less than 180 days. So plant D, the value of plant D, because first we have to calculate the depreciation, normal depreciation for the asset which is used less than 180 days. So it is 3,10,000. 3,10,000 is the which is used less than 180 days. Okay, so it is actually less than 180 days, 124 toll only it is put to use or purchased. Then it is for this value only we have to find the depreciation 50%. So on 3,10,000, 15% depreciation, 50% of 15%. That means you will get a value of 23,250. If you multiply this, you will get 23,250. Now next is actually more than 180 days, plant D is there. To calculate that from the admissible depreciation or the depreciation used for calculation see from the WDV used for calculation depreciation, we have to deduct the cost of the asset which is used less than 180 days. That means 3,20,000 minus 3,10,000 is only 10,000. 15% of 10,000 is 1,500. So total you will get 24,750. Okay. Now we have to find out the additional depreciation. So in the first case, where it is more than 180 days, okay, we have to consider the full depreciation, 20% on the actual cost. Actual cost is 1,60,000. Okay, and from the actual cost, we have to find the depreciation. So actual cost is 1,60,000. On that, we have to find the depreciation. So 20% of 1,60,000 is 32,000, and less than 180 days we have to consider only 50%, 20%. That is 20%. That is only 10%. So this is the actual cost, 3,10,000. On that 10% you are calculating, you will get 31,000. Total 60,000 you are getting. So WDV as on 1,425 is you have to deduct the additional depreciation and the normal depreciation, and you will get 2,32,250. No capital gain on sale of plant because the sale proceeds is less than the WDV. WDV is the block of asset because the sale proceeds is actually 19,50,000, whereas the block WDV is 19,50,000, whereas the sale proceeds is only 16,30,000. Therefore, the value is less than the block WDV. The sale proceeds is less than the block WDV, and hence no capital gain is admissible. Okay, on sale. Let us consider one more question. Vishal Limited is engaged in the business of manufacture of computer hardware since 1996. During the PY, now 3 blocks we are considered. Okay, and rate of depreciation 15%, 30%, 60%. 3 blocks are there. So different assets are there, and each block one asset is given. Now number of assets in the block actually block 1 there are 11 assets, block 2 there are 12 assets, and block 3 there are 17 assets. So the depreciated value of the block on April 1st, 2024 is actually 1,800,000. Okay, that means 18 lakhs. Block 2 it is 25 lakhs, and block 3 it is 5 lakhs because it is in thousands. So additional, and this additions of plant, new plants are added. Plant A, B, C are added, and plant A is added to block 1, whereas plant B is added to block 2, and plant C is added to block 3. Okay, now sale of plant is actually with each block 1 plant is sold. Okay, 1 plant from each block. So in the first block 1 plant is sold for 8 lakhs, and for the second block 28.7 lakhs, one plant was sold. And the third block for 42 lakhs, one plant was sold. Plant ABC are acquired during May 24 and plant ABC are acquired on May 24 and A and C are put to use during September 24. However, plant B is put to use in last week of March 25. Find out the amount of depreciation, additional depreciation and capital gains. Now let us see the answer. Here, first let us consider, we can compute the additional depreciation. So we know that there are three plants, plant A, B and C. Okay. And additional depreciation is always calculated on the cost of the plant. So what is the rate of additional depreciation? Rate of depreciation for plant A and C. Let us see plant A and C and B. Plant A and C, what is written here? Plant A and C are put to use on September 24. That means actually more than 180 days. September 24 means 3rd October onwards only it will be less than 179. And the plant B is put to use in March, in last week of March 25. That means it is less than 1 week used, and end of March means it is less than 179 days. That means for A and C it is 20%, whereas for B it is only 10%. And on the cost of the capital. Okay. So we know the cost of the capital. When A it is 57 lakhs, B it is 4 lakhs, C it is 70 lakhs. So the cost of the capital is 57, 4 lakhs and 70 lakhs, and the rate of depreciation is actually full depreciation we will get for A and C, whereas 50% depreciation we will get for plant B. So if we calculate like that, 57%, 20% is 11 lakh 40,000, whereas for plant B only 10% of it, because of that only 40,000, and 20% for plant C, therefore it is 20% of 70 lakhs is 33 lakh 40,000. So we have calculated total 15 lakhs 20,000 is the additional depreciation that we will get. Now let us consider the normal depreciation. Normal depreciation, we know 3 blocks are there, and already it is given. Okay, 3 blocks, 15, 30, 60% is the rate of depreciation. Okay, and the depreciated value also given, 18 lakh, 25 lakhs and 5 lakhs. So these are the amount given. Okay, so for the 18 lakhs, 25 lakhs and 5 lakhs. So now we have to add the new additions, new assets to be added along with that. So new asset, we know 57 lakhs, 4 lakhs and 70 lakhs. This is to be added with the block. So block WD, we have to add that. So we will get actually 18 plus 57, 75, 25 plus 29, 5 plus 17, 22. Okay, this is the total of this. We are with each block we are getting separately. Now from this we have to deduct the sales. Sales, we know, we see that for that sales, for block 1 it is 8 lakhs, other block 2 is 8 lakhs 70, 28 lakhs 70,000, and block 3 it is 42 lakhs. So this is to be deducted from this. So 8 lakh, 28.7 and 42 lakhs to be deducted. So what happens now from the WDV sales deducted, so we will get 74 lakhs 92,000 for block 1. For second block we are getting 30,000, but here in the third block if you see that WDV is 22 and the sale value is 42, that means sale value is more than WDV. That means the difference 42 minus 22 is a short-term capital gain for this. Okay, already it is there. So since it is more than, sale value is more than WDV, the WDV for this block, C block, will be nil there. So there is no WDV because actually you got more money than worth. It is actually more than the worth of the assets. Means WDV you are getting, and whatever difference is there, that will be short-term capital gain. Okay, therefore it will be nil. Okay, so there is now in this case there is no depreciation cases come into picture. And in the first case, the block 1, now normal depreciation we can calculate. Normal depreciation in the first case will be 15%. So on this actually 15% is the depreciation or the WDV. Okay, for the block we have to multiply by 15%, and you are getting 2 lakhs into 3,800. And the second case it is 30,000. 30,000 is WDV, and the block is 30%. Okay, and again B it is less than 170 or 180 days. We know that it is actually that is actually March 23 only it was installed, it is put to use. So for that block actually it is on the 30,000. Okay, now we are 50% only we have to consider. So we are getting 4,500. And again for the last block WDV is nil, therefore no need to calculate the depreciation. So now from that we have to deduct the additional depreciation also to be deducted. So 11 lakh 40,000 already we are calculating the additional depreciation that we are considering here. Okay, so depreciation value of the block April 1 2024 that we have to calculate. So normal depreciation is there, then additional depreciation also is there. If you deduct these two values from the WDV block, normal and additional depreciation, you will get the depreciated value of the block for this. Okay. Now for second block, WDV is 30,000, normal depreciation 4,500, and this additional depreciation is 40,000. That means actually 4,500, then the depreciation is more than the WDV. Therefore, there is the block WDV is nil. In third case, we know that actually already it is nil. Already there is actually that the WDV itself is nil. So if there is no WDV, there is no additional depreciations required. Now capital gain, as we said, actually in the third case, actually the sale value, sale proceeds is 42 lakhs. It is more than the cost of acquisition. Therefore, it's a short-term capital gain of 20 lakhs. Normal depreciation that can be claimed. Now we can claim a normal depreciation of 11,23,800 plus 4,500. So 11,28,300 you can claim as a normal depreciation, and additional depreciation of 15,20,000 in the P&L that we can claim. Now let us consider residential quarters, depreciation for residential quarters used by business. Now a residential quarters is essential for the business, means for the staff residential quarters is to be given, and it is actually incidental to the business. Then you can get depreciation on that. Depreciation is allowable on such buildings. Also, the electrical equipment and furniture provided by the assessee or the employer at the quarters are also allowable for depreciation. Okay. Now, additional depreciation is not available if the new plant or machinery is sold in the year of acquisition. Now, this year I have acquired some new equipment and I've sold it in the same year in which it was purchased, then no depreciation is available on that. Then additional depreciation is not available if the power sector unit is claiming depreciation under SLM. Okay, means actually that the additional depreciation is available to power sector undertaking only if it is opting for WDV. If it is opting for SLM method of depreciation, it will not get this additional depreciation. Okay. Now, additional depreciation is available only once for the new plant and machinery of a specified industry. Now, let us consider another question. In this, it is for a manufacturing industry. Mr. X is the proprietor, and the following information was furnished by him. So, open WDV on 1/4/24. Okay. New P&M purchased and put to use on 8/6/24. Again, new P&M acquired and put to use on 15/12/24. Computer acquired and installed in the office on 2/1/25. So, compute the amount of depreciation and additional depreciation for assessment year 25-26 if Mr. X opted out of default regime. Assume that all purchases were done through account payee checks. Now, here 2-3 figures we missed. Now here actually open WDV is given as 30 lakhs. Okay, it should be 30 lakhs here, and then again that first purchase is for 30 lakhs, second purchase is for 20 lakhs. Okay, these two figures we missed here. The computer is in the premises is for 3 lakhs. Okay, these are the figures we missed. Okay, anyway, now what happens actually here, now WDV is given 30 lakhs and asset put to use 180 days and above, that is 20 lakhs. And asset put to use less than 180 days is 8 lakhs. The total WDV is 5 lakhs 80,000. Okay. Now we have added the assets to the WDV of 30 lakhs. Now we got 58 lakhs. Now we have to consider, we have to find out the normal depreciation. So first we have to take the depreciation of the account, asset for which it is used for less than 180 days. So the asset which is used less than 180 days is to be considered first. So that actually it is actually 8 lakhs is the amount which is used for less than 180 days. Therefore 8 lakhs into 50% into 15. So we are getting 60,000 is to be deducted. Then what will happen? Then for more than 180 days from the total WDV, the cost of the asset which is used less than 180 days is to be deducted first. Then it will be multiplied by the full depreciation. So we will get 7,50,000 for that. Computer we cannot take at all because what is saying it is installed in the office premises. So something installed in the office premises for a manufacturing industry, we will not get any additional depreciation, or depreciation we will not get. But it has to be installed. It has to be installed in the manufacturing industry. Then only you will get a depreciation for that. So that we cannot use here. Okay. So normal depreciation we have calculated. Okay. Then for less than 180 days, what is used also, and for more than 180 days also we have calculated. Now computer is okay. Now 60,000 is there. Okay, but we cannot use it here for the additional depreciation. We cannot use that. Additional depreciation is actually 20% for more than 180 days and 10% for less than 180 days. So we will get actually 4,80,000 for that. So total depreciation will be the total of both. We will get 1,09,000. We will get the total depreciation. Okay. Now section 32(1)(1). It is dealing with depreciation on power sector undertaking. Now we have already discussed that SLM basis of depreciation can only be opted by power sector undertakings. They can opt SLM or WDV method. But if they opt one of these, they have to continue it for the rest of the years. Now, once they opt for SLM, then they cannot claim additional depreciation. Now, this section is for power sector undertaking and applicable only to power sector undertaking engaged in generation, transmission or distribution of electrical power. Now, they have to exercise this option before the due date of filing return on income under section 139(1). If it is auditable, the last date is 31st of October. For organization record auditing, the last day for filing ROI under section 132(1) is 31st of October, and if no audit record, it is 31st of July in the 11 PY. Now they have to select, opt SLM basis or WDV basis in the PY when they begin generating power, they begin the generation of power. Option to choose SLM or WDV once exercised cannot be reverted, that shall be final. Now the SLM option is only for the tangible assets. For intangible assets you cannot use this option. Now when they opt SLM, they can opt it actually for individual basis. I mean, it is not in a block. For each asset they can select SLM or WDV based upon their benefit. Whichever is beneficial they can select. For intangible asset, only WDV method is applicable. They cannot choose any SLM method or anything for the intangible asset. For tangible asset, on individual basis, they can decide, they can opt whether that asset is to be depreciated in SLM basis or WDV. Once they opt for that, they cannot revert back. Okay. Individual asset account system for tangible assets is applicable if SLM is opted. Now, section 32(1)(3) is discussing about terminal depreciation. So, the terminal depreciation can be written off as a loss. Yeah, in the case of asset undertaking, when they claim depreciation on asset on SLM basis under section 32(1)(1), just we discussed above, if any of the asset is sold or discarded or destroyed in the subsequent PY, then depreciation amount will be the amount by which the money is payable. Okay, this means money is payable in respect to a building, machinery, plant, furniture, together with the amount of scrap value, if any, falls short of the WDB thereof. What this means is that depreciation will be available only if the deficiency is actually written off in the books of the assessee. So this depreciation, terminal depreciation, is fully allowed as deduction as a business loss. This terminal depreciation is written off in the books of account. Now, the terminal depreciation is the positive value of the WDV of the asset minus sale value or scrap value. Now, what does that mean? This means that if the asset is sold, the sale value is less than the WDV. Okay, we have the asset, and the asset is being depreciated year by year, and we have got a WDV value. WDV means sale minus the depreciation will get WDV. Okay, and this WDV value, then at one time we are going to sell it, or we are going to transfer it. When we transfer it, if the sale value we get is lesser than the WDV of the asset, means the actual worth of the asset what we would have been received, the sale value is less than that amount, that means we have a loss. So that loss or the difference of the WDV and sale value, positive value difference, that means WDV is more than the sale value. That is the terminal depreciation. This terminal depreciation is fully allowed as deduction as a business loss, and terminal depreciation is written off in the books of account. Okay. Then monies payable means actually that will include insurance and salvage or compensation monies payable in respect thereof, and where the building machinery, plant, furniture, etc. is concerned, when it is sold, what price you are getting, that also will include in that. Now, as for section 41(2), this we already discussed in the charging section, charging part. Okay, we have already discussed this. We are discussing it again in section 41(2). What is balancing charge for power sector units? Okay, balancing charge in case of power sector undertaking claiming depreciation under SLM under section 32(1)(1), if any asset is sold, discarded, demolished, destroyed in the subsequent previous year. Okay, so that is actually then if the sale value is more than the WDV. In the former case, what we discussed is actually sale value is less than the WDV, then we will get a falsity value. But if the sale value is more than the WDV and it is lesser than the actual cost, so up to the actual cost, the difference between sale value and WDV is the balancing charge up to the actual cost. Above the actual cost, whatever we get, sale value minus actual cost, that will be short-term capital gain. Now, where the money is payable in respect to the building machinery, plant or furniture referred to in the subsection become due in previous year, in which the business for the purpose of which the building machinery, plant or furniture was being used is no longer in existence, the provision of the subsection shall apply as if the business is in existence in that previous year. Even if the business is not in existence, this can be, this section is applicable. Now let us see the different terms actually, what is our terminal depreciation and balancing charge and short-term capital gain, what we discussed above. Here this picture depicts all these things here. Now let us see that actually when what we discussed above is when sale value is less than the WDV. This is the first case we have discussed. So we have a WDV, means that we have actual cost, from that the depreciations are deducted, then what we get is WDV. When sale value minus WDV is negative, that means sale value is less than, when we discard it or when we transfer it, you are getting a sale value. When what sale value we are getting is less than the actual worth, that means the WDV. That means it is when sale value is lesser, we will get a negative value. Okay, sale value minus WDV is negative. When sale value is less than WDV, then WDV will be more. So WDV minus SV is sale value is a positive value, which is called terminal depreciation. It's a loss only. It's a loss, and that can be written off in the P&L as business loss. It should be written off in the books of account also. When sale value minus WDV is positive, that means sale value is more than WDV. Then there are two cases are there. In the first case, sale value is more than WDV, but actually equal to less than actual cost. The sale value is less than the actual cost and more than WDV. Okay, then what happens? Sale value is more than WDV and actual cost is more than equal to sale value. So sale value is less than the actual cost and more than WDV. This is what we are discussing. Then what happened? Balancing charge is the difference between sale value and WDV. Means sale value is more than WDV but less than the actual cost. Okay. For example, if your actual cost is 5 lakhs and your WDV after 1 or 2 years, okay, it is coming to maybe 3 lakhs or 4 lakhs. 4 lakhs maybe. Your WDV is 4 lakhs. Okay, but you sold it for 4.5 lakhs. But your actual cost is 5 lakhs. Sold it for, sale value is 4.5 lakhs. Okay. Then actually the sale value minus WDV is positive. And that is taxable under PGBP and it is called a balancing charge. Okay. Now we will take an example to make it easy for you. We will take the example here. Okay. Now let us consider a case. Let us consider a case where the actual cost is equal to 6 lakhs. Okay. And your WDV after 1 or 2 years, maybe let it be 5 lakhs. Or maybe 4 lakhs, say. Now you are selling it at a value less than WDV. Now when you are selling it at your sale cost, first case 1, sale value is 3 lakhs. In this case, what will happen? Sale value is less than the WDV. That means you are at a loss of 1 lakh compared with the WDV. Okay, WDV is the worth of the machinery after depreciation are deducted from the actual cost. So you have got a loss of 1 lakh. This loss, then the difference between WDV, that 4 minus 3 is equal to 1 lakh. This will be your terminal depreciation, and that should be written off in the P&L and should be written off from the books of account also. That will be treated as a business loss. Let's take another case in which actually sale value is 5 lakhs. For example, sale value is 5 lakhs. Okay, that means this 5 lakhs is okay, this 5 lakhs is actually less than the actual cost of 6 lakh and it is greater than the WDV of 4 lakhs. Okay. In such case, what will happen? Now, since it is less than this, so the difference between the sale value, that is 5 lakhs minus 4 lakhs, is the positive value. Okay, that is 1 lakh. This 1 lakh is your balancing charge under PGBP. This balancing charge is chargeable as income under section 41(2) as PGBP income. Now let us take the third case. Now your actual cost we know 6 lakhs. Let the sale value, in this case, let sale value be 7 lakhs. Okay, WDV we know 4 lakhs only. Sale value is more than the actual cost. So up to actual cost. Okay, up to actual cost, sale value is more than WDV, 7 lakhs and 4 lakhs. Okay, that's correct. Here actually actual cost 6 is less than the sale value. So up to the actual cost is 6 lakhs minus 4 lakhs, that is 2 lakhs. This will be the balancing charge. Okay, and after the actual cost is reached, means more than the actual cost, whatever amount you are getting, that is 7 lakhs minus actual cost of 6 lakhs is 1 lakh. This will be above the actual cost. Whatever the sale value is there, that will be short-term capital gain. Okay, that is under 50, under section 50 of capital gain, under section 50. Okay. Now we can see it here. Same thing is said here. Okay. Now, okay. As per section 41(2), in case of power sector undertaking which claim depreciation under section 31(1) is so discarded, the amount chargeable to income tax as income of business of the previous year is the balancing charge, which is the amount by which the money is payable. This is what we have discussed. Okay. So, in other words, balancing charge is the profit on account of such assets of the maximum of the accumulated depreciation. One thing we have to take into consideration is that actually the balancing charge cannot exceed the accumulated depreciation. It is not possible to, and if that is the reason here now, because actually the depreciation, if it is actually more than the depreciation, up to the depreciation can be maximum of the actual cost only. Okay, so that cannot go more than the actual cost also. So that cannot be accumulated depreciation. It cannot go more than the accumulated depreciation. Balancing charge is equal to negative value of the WDV of assets. Sorry, it is the value of balancing charge is the negative value of the WDV of asset minus sale value, or the positive value of sale value minus WDV. Both the same. Okay. Now, it is the difference between sale value and WDV. Balancing charge will come into picture when sale value is more than the WDV. Okay. Now, in this case, actually, we have to take a negative value because actually WDV will be less and sale value will be more. Therefore, negative value of the WDV minus sale value is a negative value. Negative value is positive. That way, balancing charge is considered. Balancing value cannot exceed the accumulated depreciation claimed on such asset. This is what is important. Balancing charge cannot exceed the accumulated depreciation. Okay, balancing charge cannot exceed the accumulated depreciation. Now, as per section 41(2), balancing charge is fully taxable as business income. So, balancing charge is a taxable income, is a PGBP income in the previous year in which such income falls due. The provision holds good even if the business does not exist in that year. Is what? Even if in that year, when we charge the balancing, when we calculate the balancing charge, when the asset is sold, the business may not be there. That year, actually, the business may not be there. Even then, it holds good. Difference between sale price and actual cost shall be treated as capital gain. So when the sale price is more than the actual cost, difference between sale price and the actual cost is the short-term capital gain as per section 50A. Let us now consider one example. A limited is a power sector undertaking. Now this is actually only for power sector undertaking. The SLM can be used only for power sector undertaking. Now this example also we are discussing about power sector undertaking only. The A limited is a power sector undertaking. Purchased the plant for rupees 50 lakhs on 1/4/22 and it is eligible for depreciation at 15% on SLM. Compute the balancing charge or terminal depreciation assuming the plant is sold on 21/4/2024. After 2 years, the plant is sold. 1/4/22 it is purchased. So then 1/4 mean 22/23, that first year. Second year 23/24. So it was sold on 21/4. Okay, mean up to 31/3, 2 year completed. Then the next year it is sold. The sold, we will consider 4 cases. First case is actually 7.5 lakhs. Second case is 30 lakhs. Fourth case is 45 lakhs. Fifth case is 55 lakhs. Now, in this case, what will be the WDV on 1/4/24? Because actually the depreciation rate is 15%. It is SLM basis. SLM basis, SLM is what will happen on the actual cost. You have to use the same depreciation. WDV means that will not. In WDV method, what will happen? We have to first year we will calculate the depreciation that will be deducted. What we get the WDV or the WDV we will for second year we will multiply the WDV at the end of the year, that will be multiplied by the depreciation next year. But in SLM basis, that is not the case. Same actual cost will be multiplied by the depreciation percentage in every year. Okay. Here the actual cost is 50 lakhs. 50 lakhs is first year. This is actually 1/4/22. Okay. The cost is 50 lakhs. Then it is then for that year actually 22/23 depreciation is 15%. You can see here computation how that will be calculated. Original cost 50 lakhs less depreciation 22/23 15% is 7.5 lakhs. Okay. We are actually that scrap value is assumed nil. Okay. Now WDV as on 1/4/20. I mean again next year, next year WDV again depreciation will be to be deducted. Then we will get 35 lakhs. In all the three cases, WDV as on 1/4/24 is 35 lakhs only. Now the sales proceeds we have to deduct. Sales proceeds first case it is 7.5 lakhs. So it is sold for 7.5 lakhs when in actually 21/4/24 it is sold. Now here what happened? The sale value is less than the WDV. In such case, what we will get? We will get the terminal depreciation. When sale value is less than the WDV, we will get the terminal depreciation. So the difference between sale value and WDV is 27.5 lakhs is that will be the terminal depreciation. So there is no balancing charge or there is no short-term capital gain. Nothing is there because only terminal depreciation is a business loss. Okay. Now in second case, it was sold for 30 lakhs. Now what happens? The sale value is less in this case also. The difference is 5 lakhs. So this 5 lakhs is terminal depreciation. Okay. Now in the third case, the sale value is 45 lakhs, which is 10 lakhs more than the WDV. But the 45 lakhs is less than the original cost of 50 lakhs. Okay, actual cost less than actual cost, but actually more than the WDV. In such case, what we will get? We will get the balancing charge. Okay, so the difference is balancing charge since it is less than the actual cost. Now, next case 55 lakhs it is sold. Means it is more than the actual cost of 50 lakhs. So up to 50 lakhs we will get balancing charge. After 50 lakhs we will get the short-term capital gain. So 35 minus 50 lakhs. 50 lakhs will be the balancing charge and the 55 minus 50, 5 lakhs will be the short-term capital gain. Okay. Now the balancing charge cannot exceed accumulated depreciation claimed on such assets. This is what we have discussed above also. Okay. The total negative balancing charge in case of D is 20 lakhs. Okay. In case of D, so what will happen in case of D, case D? Case D, it is actually 20 lakhs. 20 lakhs. So because it is a negative balancing charge, it is a 20 lakhs only. But we cannot claim 20 lakhs for balancing charge because the depreciation is only 15 lakhs. 50 is the original cost and WDV is 35 and 50 minus 35 is the depreciation. Maximum 50 lakhs only we can charge for balancing charge. The balancing charge cannot exceed the accumulated depreciation. So the rest we have to charge in short-term capital gain. This is what we have done here. Okay, the same thing is being told here. Actually, the difference is 20 lakhs balancing charge, which is more than 50 lakhs, 15 lakhs. Therefore, the accumulated depreciation of 15 lakhs, we have to consider for balancing charge. Then balancing charge is restricted to 15, and the balance 5 shall be treated as short-term capital gain. Let us consider one more example. So, B Electric Supply Company Limited, which is charging depreciation on SLM, whose actual cost of asset was 20 lakhs and WDV is 18 lakhs 72,300. Sold the said asset during 24-25 after 2 years. So 2 years, it collected or it claimed the depreciation 2 years on SLM basis. Then after that, actually, it was sold. What will be the tax treatment for assessment year 25-26? Therefore, that means previous year 24-25. If the asset is sold for, there are 4 cases. First case is 30,000, then 80 lakhs 72,300. The same price. What WDV? The equal WDV. Then less than WDV. Then 19.8 lakhs more than WDV. This is 21 lakhs is actually more than the actual cost. So 4 cases we are considering here. So we know that actually WDV is already given 80 lakhs 72,300. It's the same for all 4 cases. Less sales proceeds. First case it is told 30,000. Second case 80 lakhs 72,300. Same price, more than the WDV, more than the actual cost. So in the first case, what will happen? The sale price is less than the WDV. Therefore, what we will get is the terminal depreciation. Okay. Now in the second case, both are same. WDV and sale cost is same. Therefore, there is no terminal depreciation, no balancing charge, no short-term capital gain. Nothing is there. Okay. Balance is 0. And in the third case, actually, sale value is more than the WDV. That means you have a case of balancing charge. Okay. So you are 10,000. Sorry, 1 lakh 7,700. Okay, that will be your balancing charge. Now, in the fourth case, you have a case of balancing charge and a short-term capital gain. Because short-term capital gain, why? Because it is more than the actual cost of 20 lakhs. 20 lakhs is the actual cost. So, up to 20 lakhs, it will be 2,27,700. It will be the balancing charge. Okay, up to because see the difference in this image. Therefore, sorry, up to 20 lakhs mean 1,27,700. That will be the bank's in charge, and the rest of the amount 1 lakh, 21 lakhs minus 20, that is the short-term capital gain. Okay. Now let us try to understand what is meant by actual cost. What is the definition of actual cost, and how actual cost is calculated. Section 43.1 explains the actual cost. Now, actual cost is actually the cost for which the asset is acquired minus the cost of acquisition or construction. Okay, or you can say that, or if you are getting some government grant or something, that is to be deducted from that. So it is the net cost. Actual cost means the actual cost of the asset to the assessee reduced by the portion of the cost thereof, if any, as has been made directly or indirectly, or indirect cost and indirect cost will be deducted from the cost. The following costs shall be included in the cost of fixed asset to calculate the actual cost. What are the costs that we can add to the actual cost to come to the actual cost? That is also another thing. Now what we told first was actually the actual cost, how it will be calculated, what are the things to be deducted. Now what are the things that can be added to come to the cost of the asset, cost price of that or actual cost of the asset. There are two parts are there, and in what can be added. First is the cost price of the asset. Now interest or on money borrowed for the purchase of the asset till the asset is put to use. Okay, we are buying some asset, and from the date of purchase, okay, to the date of put to use, we have to pay some interest on that, on the borrowed money. If you have taken money from the bank, on the borrowed money, some interest is to be paid. Up to the date of put to use, whatever money is coming, that will be added to the capital asset. That cost will be added to the capital asset. Okay, bank charges, then charges on bank guarantee, LC, everything will come into that. Letter of credit. What is letter of credit? Now, okay, let us see what is letter of credit. Letter of credit is actually a contractual commitment by a foreign buyer's bank to pay when the exporter ships the goods and presents the required documentation to the exporter's bank as a proof. Okay. Now, you are buying some asset from a foreign country. So you don't know, if you pay the money in advance, you don't know whether that person will send the asset to you. And if that person sends the asset to us, ship the asset to us, he is not sure whether he will pay the money or not. There's a mistrust. So for that actually the letter of credit is coming into picture. So it is a contractual commitment by the foreign buyer's bank to pay when the exporter ships the goods. Now if we are buying, our bank will give will give a commitment, contractual commitment, that once the shipment is done, okay, and if the documents are presented to the bank as a proof of that, then the money will be transferred to him. As a trade finance tool, letter of credit is designed to protect both exporters and importers, and both exporters and importers are getting the benefit of this. They can help you win business with the new clients in foreign markets, because we don't know what we have in the other end. So there is a there will be some kind of mistrust between both. So to mitigate this kind of thing, the letter of credit is coming into picture. This means that the exporter gets a guarantee of payment while offering the importer reasonable payment terms. Now there is something called bank guarantee. So what is bank guarantee? A bank guarantee is a promise from a bank that it will pay the third party if the debtor defaults the loan or contract. It's a way to build trust between businesses, especially for large transactions. The bank acts as a guarantor for the debtor. If the debtor doesn't pay, the bank will pay the third party. Okay. For that, the bank may ask for some collateral or deposit something from you. That is also there. Okay. So bank guarantee, the bank promises that in case, for example, I will take a very small example. Now there is a contract is there. In the contract, one term is there. If the asset is not supplied in time, so there will be some charges will be there, some compensation will be paid. So this actually we are keeping our money in our bank, and the bank will give a guarantee to them. Actually, okay, it is not paid in time. Actually, this money will be transferred to them. Transferred to them. That compensation will be paid. Like that, some guarantee bank is giving. So if they give the proof that it is, the party has defaulted, okay, then actually the bank will give the compensation money to the other party. Like that, there is a bank guarantee. The bank is given the guarantee, assurance. This is what is called bank guarantee. Now, direct expenses including traveling expenses for acquiring the asset. This can be added to the cost of the asset. Okay. Now, the cost for bank guarantee, LC, okay, the interest on money borrowed for purchase of asset till the asset is put to use. Then cost of the asset, of course, it is there. Then direct expenses including traveling expenses for acquiring the asset. Okay, if you are acquiring the asset from China, you have to travel to China, you have to check it, you have to go to the factory, you have to test the equipment there, you have to find out whether it is actually usable for your production, all the things you have to do. So there is expense for that. This expense can be added to the cost of the asset. Then once the asset is brought, then you have to install it. There are some installation charges. That means you have to make a foundation or whatever. Then actually some charges are included, incurred for you. That charge also can be added here. The cost of repairs and modification prior to use of the asset to make it ready to use. Okay, once it reach here, it is not compatible, or maybe you have to make some adjustment, some modification you have to make. Then only it will be suitable for Indian conditions and all. That cost also prior to use of the asset. If you have done some modifications repair, that cost also can be added to the cost of the asset. Some training expenses of the staff before the use of the plant. The staff is to be trained, so the training expense also will be added to the cost. Then expenses on essential construction work such as foundation to fix the machinery, cold storage rooms, cooling towers. Okay, if you want some cooling towers or something, okay, maybe some cold storage rooms and all, everything can be added with this. Expenses necessary to bring the asset to site, installation, and to make it ready for use, carriage inward, loading and unloading, trial run cost, installation charges, everything can be added till it is put to use. Whatever cost is incurred till put to use can be added to the cost of the asset. If you get any revenue by selling the trial run products, okay, now you have tested your machinery and some trial run is done, some products are produced, some items are produced. Now this, if you're getting some amount out of this by selling this, that should be deducted from the cost of asset. If you get any revenue by selling the trial run product, it should be deducted from the cost of asset. It should not be transferred to P&L as income. It is not an income, because income will come when you have commercially started the production. You are not commercially started the production, you have just tested it and some trial run conducted and some items were produced and the quality were good, actually you can sell it, and that amount will be deducted from the cost of asset. Whatever cost is there, you can deduct it from that. Okay, it is earned before the commercial production or put to use. Expense on insurance, power and fuel incurred before the commencement of business. Okay, now you go, some insurance expenses you actually incurred, okay, or some insurance you have taken on the machinery. All these things before commencement business can be incurred. Some maybe some fuel is required, some diesel required for running the machinery. That cost also you can add here, or maybe power supply cost. That also, whatever cost before the commercial production or put to use can be added to the cost of the machinery as a capital expense. Expenses that are incurred for increasing the capacity to or make it fit prior to use. Okay, if you want to increase the capacity, some capacity to be increased. Okay, now you brought the machinery, but actually the space is not enough. So what you will do, you have to increase the space. So that expense actually to increase in the capacity, then only it will fit there. Or actually once the things are produced, actually then you need more storage spaces. For those storage spaces, there required whatever production is done, you have to store it. For that, actually for increase the capacity, you need storage space also. That is a part of it. Therefore, that expense can be also added to that. Now we can say, what are the events that can be added to capital cost? Loan taken to purchase the asset. Okay. Then the purchased asset, then installation cost, then trial run cost till ready to use, the put to use. So up to put to use, whatever cost is there. If we take the interest, for example, interest till the date of put to use can be capitalized till the point that is added to the cost of asset. After is put to use, the interest is revenue expense. Then loan repayment and interest and EMI, everything will be revenue expense after that. Now, computation of the actual cost, if you are saying actually the cost of acquisition, okay, and you have to add the interest on loan till put to use or over date of commencement production, all these are capital expenses. Then you get interest is capital expense till put to use. After that, it will be revenue expenses, which are the P&L. Then expenses incurred for acquiring asset, we are told actually freight, insurance, loading, unloading, everything will be added to the capital expenditure. Now, expenses incurred in connection with installation charges, trial run charges, Then forex fluctuations for assets acquired from abroad. Okay, some forex fluctuation when actually that repayment started, actually that time before the machinery is put to use, whatever forex fluctuations, because you purchased, okay, the asset when the dollar price in rupees was 84 rupees, and when you are trying to repay, the amount is coming to 90 rupees, okay, per dollar. So there's the fluctuations there, and that difference in fluctuation of the dollar, because of that actually forex fluctuations, okay, that will be added to the capital cost. Now less any amount received from trial and product selling on all. If you say sell the trial and product, we'll get some more. Then subsidy or grant received by from government, by authority, directly, indirectly. Then actual cost for computing that is the actual cost for the computing the present. Then that will be the actual cost. You deduct these two costs, then you will get the actual cost. Let us discuss some points regarding the actual cost. The maximum amount that you can spend in cash for acquiring any asset is 10,000 rupees per day per asset. More than that, if you are spending, you cannot be included actually for the calculation of actual cost. Okay, you have to do the payment through bank only, through account boy check or through net banking or any other electronic transfer you have to do. If you have paid the amount through by cash for more than 10,000 rupees per day per asset, then you will not consider it as in the actual cost. Any expenditure on acquisition of any asset shall be ignored if such expenditure is made in cash exceeding 10,000 per day per bill. For example, if a machine purchased by paying 20,000 cash, 30,000 by bank, then only this 30,000 will be considered, because the 20,000 cash paid is actually more than 10,000. So that will not be considered. Only 30,000 will be considered as the cost of the account, and you can claim depreciation only in that amount. Now we will consider 2 examples. One machine purchased for 20,000, cash paid 10,000 in one day, morning 10 a.m. and evening again you made actually 10,000. That means in a day more than 10,000 paid here, 20,000 paid. Therefore, it is not allowed. Okay. The second example. Okay. Second example is machine purchased for 1 lakh, and every day 10,000 paid in cash for 10 days. So that is allowable. Why? Because one day that shall not exceed 10,000. And third case, machine purchased for 30,000, and actually one day you paid 5,000, second day you paid 10,000 in cash and balance in account pay check. That is allowable. Why? Because in cash you have paid only 10,000. More than 10,000 per day you paid in cash. Account pay check is actually always allowed. So there is no issue in that. Third case, 2 machines you purchased X and Y, one for 8,000, second for 7,000. You paid cash of 15,000. This is also allowed. Why? Because actually per bill you can pay per day only 10,000. These are actually 2 separate machines, actually separate payment. Therefore, paid in cash 15,000 for 2 machineries. Therefore, it is allowable. Now, scientific assets. For example, you will consider that scientific asset or actually specific business asset. Scientific asset under section 35 and specific business 35D. We will learn all the things actually in the coming sections and all. You will learn. Okay. Now, for the time being, I am just mentioning this. Please bear with me. Okay. And these 2 cases, we are getting 100% deduction for depreciation. So, some asset was brought to business and we claimed the depreciation under 35 or 35D. Okay, 100% deduction we obtained. Such case, actual cost is actual cost with assessee minus deductions taken. It will be nil. Therefore, actual cost, your actual cost is nil in this case. Why? Because you have taken 100% deductions. So there is no cost for you. Actual cost should be considered as nil. Already 100% deduction allowed to you. Now, another case is the conversion of stock in trade. Some stock in trade, if you are converted, okay, if you have some AC and you are a AC dealer, you have one AC you use for your office. That means your inventory is converted into capital asset. In such case, actually, you have to consider the fair market value of the inventory that is converted into your asset as your capital asset. Will be your actual cost. Okay. then you are converting your stock in trade to capital asset. So the cost of, the fair market value of the stock in trade you have to consider for your actual cost. Now, you acquired some assets by gift or will or inheritance, something like that, you acquired. So the actual cost when you are when you are calculating, it should be the WDV in hands of the previous owner. The previous owner actually, okay, he purchased this, he has actually availed some deductions on that, maybe depreciation they deducted, then he has a WDV from the date of purchase. So that WDV in the hands of the previous owner, okay, that means actual cost minus accumulated depreciation is the WDV, that's for the previous owner. Okay, the same WDV will be the actual cost in the hands of the, same WDV, that will be the actual cost for you when it is inherited to you. Okay, now next case we can consider, okay, some second-hand machine you are purchasing, maybe at a higher cost or whatever. So you have not availed any depreciation for that, or your previous owner also not availed in depreciation on that second-hand machine you are purchasing, and that machine, and for you can, for an amount you purchase maybe at a higher rate than the fair market value, whatever, for that amount you can avail the depreciation on that. Okay, so that you will show it as your actual cost. But actually, if the assessing officer of income tax is convinced that you have done so, okay, you have purchased a second-hand machinery to reduce the income tax liability, because you have to show higher depreciation and you can reduce your income tax liability. For that purpose, that being your purpose, you have purchased the second-hand machinery and brought into your business. By claiming depreciation for enhanced cost, you can you can reduce your tax liability. If the assessing officer, okay, now convinced that, then actually the assessing officer with the previous approval of the Joint Commissioner of Income Tax can determine the actual cost with regard to the facts and circumstances of the case. So he can assess the actual cost. In such cases, the assessing officer will assess the actual cost for you. Now, reacquisition of transferred asset used earlier for one's business or profession. Now, you have sold your asset, now you are reoccurring it, you are buying back again. Such case, actual cost will be the WDV at the time of first transfer or the price paid for reacquisition, whichever is lower. So, you transferred it or you sold it. What will be the WDV at that time for you? Or the price you paid for reacquisition. When you brought it back, or when you bought it back, what is the price you paid? And whichever is lower, the WDV or the price you paid, whichever is lower, that will be the actual cost. Now, sale and leaseback transactions. This case actually, assets acquired by an assessee from another person. Okay. Now, Mr. Y is buying an asset from Mr. X. Asset acquired by an assessee or transferred from another person. Okay, seller or transferor, whoever. Okay, he is buying it. Who used it for his business or profession? And one person was using one asset for his business or profession. From him, another person is buying it. X is having an asset, he is using it for his business, and it is being transferred to Y. Y is buying it. Okay, and what he will do, he will lease it back to X again as a lessor. Okay, in such case, then he let out on hire or lease to the same person who had earlier claimed depreciation on such as asset, and X was using the product for his business and he was claiming depreciation on that, and he has sold it to Y. Then he has taken back on lease from Y. Okay, in such case, WDV in the hands of the transferee is equal to WDV in the hands of the transferor, from whom he has acquired and whom it was leased back, is equal to actual cost of the transferee. So what will be the actual cost for the transferee or the lessor who bought the asset from X? Here the case of Mr. Y, he bought it from X. Then actually what was WDV when he was transferring to Y will be the actual cost for Mr. Y or the transferee. Now, building used for non-business purpose earlier was brought into business subsequently. Okay, I had a building. The building was used for my personal purpose. This building, on one particular date, I am transferring to my business. I am using it for business. So the actual cost of the building when brought into business. Then when I brought the building to my business, what is my actual cost? The actual cost will be the depreciation calculated the right in force on the date that would have been allowed had the building been used for the business purpose since the date of acquisition by the assessor. I have acquired a building and the building was used for my personal purpose. I used it for 2 years. Then the third year I brought the building to my business. Then you have to calculate the WDV as if the building was in business from the date of acquisition. When the day I purchased it, bought it, from that date onwards, 2 years if I use for personal purpose, that also you have to consider for the 2 years also. You have to calculate the depreciation and WDV. And the third year, when it brought to business, what will be the WDV? That WDV will be your actual cost. One example will show you Mr. A acquired a building on 21-22 previous year and used for personal purpose. In 24-25, okay, brought the same to his business. That means 21-22 he brought, then 21-22, 20-23, then 23-24, 3 years. Okay. Then the actual cost of the building when brought to business is equal to WDV of the building as if it was used for business from the date of acquisition, which is equal to actual cost of the building when purchased in 21-22 less depreciation for 3 years, that 21-22, 22-23 and 23-24 at current rate, at the depreciation rate when it was brought into business. For that previous year, what was the current rate for, current depreciation for the building? That depreciation rate is applicable for that rate you will consider for all the previous 3 years. You have to consider the depreciation, and that is to be deducted from the actual cost to come to the WDV, and that WDV will be your actual cost. Notional depreciation and the rate applicable at the date of conversion. Okay. And this is applicable only for buildings and not for plant and machinery. Now, next explanation is actually explanation 6, 7 and 7a. All these things together we can say in this fashion: actual cost to the transferee company, amalgamated company or resulting company shall be taken to be same as it would have been if transferee company, amalgamated company or the resulting company had continued to hold the capital asset for the purpose of its own business. So same cost for WDV at the time of transfer. I will explain it. Now let us consider the case. We have a capital asset, and the capital asset, okay, the holding company is having capital asset. The holding company is transferring the capital asset to its subsidiary, 100% subsidiary, or vice versa, or subsidiary company is transferring to its holding company. That is the first case. So there is a transfer company. Transfer company is the company which is transferring the company. Transfer company is which is receiving the asset. Or a second case is actually the amalgamating company is transferring the asset to the amalgamated company, or the demerged company to the resulting company or the demerged company. We know all these terms: what is the demerged company, what is the amalgamated company, what is the holding company. All these things have been already discussed. Okay. Now, in such a case, when a holding company is transferring its capital asset to its 100% subsidiary, then amalgamating company transferring to amalgamated company, demerged company to resulting company. In such cases, how the actual cost is calculated? Then what is the actual cost in such case? In all these cases, the actual cost to the transferee company or the amalgamated company or the resulting company, amalgamated company or transferee company, being an Indian company, shall be taken to be the same as it would have been if the transferee company or amalgamated company or resulting company had continued to hold the capital asset for the purpose of its business. So that means there would not be any change. Whatever be the actual cost of the holding or the transfer company, the same cost, okay, will be applicable to the subsidiary company. There will not be any change, as if the transferee company is holding the asset from the very beginning. That fashion we have to consider. Actual cost of the transferee company shall be taken as the same as it would have been if the transferee company continue to hold the capital asset. It is continue to hold the capital asset from the very beginning, okay, for the purpose of its business. When it is continuing, that means earlier also it was with the same company. Like that we have to think. So there won't be any change. Whatever be the actual cost for the transfer company, and the same cost will be applicable to the transfer company also. Okay. Now, yeah, some transactions are some transactions are not regarded as a transfer. If a transfer of a capital asset by a company to its subsidiary company, if the parent company or its nominees hold the whole of the share capital of the subsidiary company and it is an Indian company, subsidiary company is an Indian company. Okay. In transfer of capital asset by subsidiary company to the holding company, if the whole of the share capital of the subsidiary company is held by the holding company and the holding company is an Indian company. Okay. Then in this case also the transactions are not regarded as a transfer. Now let us consider the explanation 8, explanation 8. Okay. Now we have considered 6, 7, 7a. This is explanation 8. Interest on capital borrowed, capitalization of interest in connection with acquisition of an asset. Now how we will treat the interest on capital borrowed? This we already covered. Then I am explaining once more. Interest relating to a period after the asset is first put to use will not be part of the actual asset. Mean up to put to use, whatever interest is there, that will be part of the capital cost. After that, it will be revenue cost. Till the time put to use, all expenses shall be capitalized and will form part of the actual cost. And after put to use, the interest will be revenue expense. Now, capitalization implies inclusion of such interest in the actual cost of the asset for the purpose of claiming depreciation, investment, allowance, etc. Now, explanation 9. Adjustment of claim of credit on taxes. Amount of duty of excise or additional duty leviable shall be reduced if credit is claimed and allowed. In case we are refunded or getting back the tax is already paid for excise or additional duty or GST, whatever taxes, if we are getting a refund, then that duty will not be adjusted against the actual cost. Actual cost of the asset shall be reduced by the amount of duty of excise or additional duty leviable under section 3 of the Customs Tariff Act 1975, in respect of which claim of credit is allowed under central excise rules. In case these rules are getting adjusted, then it is refunded, then actually this amount, the tax amount, to be reduced from the actual cost. Next is explanation 10. Subsidy or grant reimbursement on investment capital, specific and general subsidy, grant or reimbursement. Whenever you get a subsidy or a grant from the government or maybe some other organization, and that amount should be, the subsidy should be reduced from the actual cost, where a portion of the cost of the asset has been met directly or indirectly by a state, central government, or any authority established under any law, or by any other person in form of grant, subsidy, reimbursement. Such amount will not be included in the actual cost of the asset to the assessee. Mean that cost, if you get a subsidy, that is to be deducted. In case a subsidy, grant, reimbursement cannot be directly related to the asset acquired and is for general nature, proportionate subsidy related to the asset shall be reduced from the actual cost. Now, explanation 11. Asset acquired outside India by an assessee, being a non-resident, and such asset is brought by him to India for the purpose of business or profession. In this case, okay, you are a non-resident Indian. You have acquired some asset while you were outside India. Then later you are bringing that asset to India. In such case, how the actual cost is calculated? Actual cost of the asset shall be reduced by the amount equal to the amount of depreciation calculated at the rate in force that would have been allowable had the asset been used in India for such purpose since the date of acquisition by the assessee. That is, actual cost will be WDV. What this means is that you will calculate the actual cost in such a fashion that that asset is being been purchased in India, or the when you acquired that asset, from that date onwards you have to calculate the depreciation at a rate applicable at the time of transfer of the asset to India. Then for maybe after 3 years you are bringing back to India, then for 3 years you have to calculate the depreciation, and that is to be deducted from the actual cost. Then you have to calculate the WDV, and that WDV will be the actual cost of the asset when it is brought to India. Now, explanation 30. Actual cost of any capital asset on which a deduction has been allowed or is allowable to the assessee under section 35 AD shall be nil. Okay. Now 35 AD specific businesses. For specific businesses, 100% deduction is allowed. In such cases, the actual cost is considered nil. Okay. Capital asset on which deduction is allowable under section 35 AD. Actual cost of the capital asset on which deduction has been allowed or is allowable to the assessee under section 35 AD shall be nil. This will be applicable in the case of transfer of asset by assessee where, and there is one case. Second case, actually the assessee himself claimed deduction under 35 AD. Now the assessee has claimed a deduction, 100% deduction under 35 AD. Then after that, actually the cost of asset is nil because 100% deduction he has received. Or when he is acquiring the asset from another person, okay, then the previous owner has claimed the depreciation under 35 AD, then also the cost will be nil. Okay, actual cost will be nil. This would be applicable where the capital is acquired by the assessee by way of, then if the capital asset is acquired by way of gift, will, or irrevocable trust, by any distribution of liquidation of company, when a company is liquidated, okay, when it's wound up, okay, then also, okay, now also he has acquired in such a fashion, then also it is the cost, the actual cost is considered to be nil, or partial or total partition of HUF, okay, Hindu undivided family. Transfer of capital asset by holding company to its 100% subsidiary or vice versa. Okay, some asset is being transferred by a holding company to its 100% subsidiary or vice versa. That case also the cost is considered to be nil, being an Indian company. By amalgamating company to amalgamated company, being by an Indian company, by an amalgamating company to amalgamated company, demerged company to resulting company, being an Indian company. In all these cases, capital cost is considered nil. Any transfer of capital, intangible asset by a firm to a company as a result of succession of a firm by a company, or transfer in the course of demutualization or corporatization of the recognized stock exchange in India, and as a result of which the association of persons or body of individuals is succeeded by a company. Now, in transfer of capital or intangible asset by a firm to a company, a firm has transferred capital asset or intangible asset to a company as a result of succession of a firm. As a result of succession of a firm, actually, no, that the firm is by succession is taken over by a company. Then that case also the cost will be nil. Okay, the actual cost will be nil as far as the company is concerned. Now, any transfer of capital asset or intangible asset by a sole proprietary concern is succeeded by a company. When a transfer of a capital asset of intangible asset by a sole proprietary concern is succeeded by a company, in that case also we can consider it as nil. Any transfer of capital asset or intangible asset by a privately limited company or unlisted public company to an LLP as a result of conversion of such company to LLP. A company is being converted into a LLP. So any transfer of capital asset or intangible asset by a privately limited company or unlisted public limited company to an LLP, that case also the actual cost shall be considered nil. However, where deduction is allowed under 35 AD is deemed to be an income of the assessee in accordance with the provisions of section 35 AD, being used for other than specific. All these cases we mentioned above, when it is being for the same use, For 35 AD only means for specified users, means already 100% deduction allowed. That's why it is nil. Okay, all cases, whether it is actually transferred from one company to other, from actually amalgamating company to amalgamated company, all these cases it is used for the specified businesses. That's why the cost is nil, because 100% deduction already available. But you are not using for the specific business, you are using for other businesses other than specific business. That case, actual cost of the asset to the assessee shall be actual cost reduced by the amount of depreciation allowable. Okay, when it is used for other businesses other than specific businesses, then actual cost of the asset to the assessee shall be actual cost reduced by the amount of depreciation allowable. The depreciation to be reduced had the asset been used for the business calculated at the rate in force in the date of acquisition. So if you have transferred to other businesses other than specific businesses, then you have to consider that from the date of acquisition you have to calculate the depreciation, and that depreciated amount to be reduced. Then the balance amount, whatever WDV you are getting, okay, then you will get the actual cost. You have to deduct the depreciations. Actual cost of the asset to the assessee shall be actual cost reduced by the amount of depreciation allowable had the asset been used for business. In the business, it has been used. It has been used for the business from the very beginning and the date of acquisition. Then actually, accordingly, you have to calculate all the depreciations, and depreciations to be deducted from the actual cost. Then that amount will be the actual cost for the business. Depreciation in the case of amalgamation, demerger, succession, business reorganization, where in the previous year there takes place succession of a partnership formed by a company or a proprietary concern by a company, that is change in ownership, succession of a private limited company or unlisted private company, succession of a business other than by death, amalgamation or demerger company. In such cases, depreciation shall be calculated as if no change in ownership has taken place. So we will consider there is no ownership taking place. We will calculate the depreciation as if there is no ownership change. Okay. Then the amount of depreciation, when the depreciation amount is calculated, it will be apportioned between the predecessor and the successor in the ratio of the number of days of the assets were actually used by them. So the predecessor and successor, they were using the asset, or actually predecessor has used for some days and successor has used for some days. And after the number of days, the depreciation is apportioned between these two. The depreciation shall be at first computed as if the amalgamation or demerger succession has not taken place. We will not consider that such an event has happened. Okay, so as if nothing happened, we will calculate the depreciation based on the rate of depreciation. Such reduction shall be apportioned between the transferee and the transferor in the ratio of the number of days for which the assets were used by them between the old and the new owner. Sale consideration, if any, received for the transfer of assets to resulting company is irrelevant in this case for the calculation of depreciation. Ignore if given in the question. Okay, sale consideration is immaterial for this. Okay, we will not consider about the sale consideration. We will consider the actual cost only. We will consider the depreciation, and the depreciation will be apportioned between these two. Let us consider an example. Now there are two companies, A Limited and B Limited, and A Limited and B Limited amalgamated on 5/8/24. Okay, A Limited and B Limited, A Limited and B Limited amalgamated on 5/8/24. Okay, and there was an asset X with A Limited that of value of cost 1 lakh. Suppose let there be an asset X with 1 lakh with A. Then at the date of amalgamation, means from 1/4/24 to 4/8/24, it was with A. Once it is amalgamated, then from 5/8/24 to 31/3/24, the year is actually the year 1424 to 31.3. From 5.8 to 31.3 is with B. So we have to calculate how the depreciation as if there is no amalgamation. For the full year we will calculate because it is the asset is with A from 1/4 onward. That means more than 180 days. That means full depreciation it will get. So for the whole year we will calculate the depreciation. Means actually it's 1 lakh 15% depreciation. The block is 15% block. Okay. So the 15% depreciation it is 15,000 rupees. Now from the asset X, we use the year limit, days of use, how many days is used? 1424 to 4824. That means 1424 means actually April there is 30 days, May 31, then June 30, July 31, August 5/8 means August up to 4 means 4 days from here, total 126 days. And out of the August there are 31 days, and if you deduct the 4 days, there is 27 days. So with the B, it is in August it was in 24 days it was with the B. Then you calculate the September 30, October 31st days, then November 30 days, December 31st, January 31st, and then February 28 days and March 31 days, total through 239 days. And out of the 365 days, since it is not a leap year. If it leap year, it would have been 366 days. Okay, 126 plus 239. Okay, so it will come 365. So the number of days we will calculate. The asset was with the A for 126 days, the X was with the A for 126 days, and with the B it is 239 days. So the total depreciation is 15,000. So 126 divided by 365 into 15,000, the A will get a portion of portion of the depreciation 5,178. And the asset was with B for 239 days, therefore it will get a 9,822. Like that the depreciation is apportioned between these two. Now let us consider another asset, because one asset Y was purchased for 60,000 on 6/6/24. That means the asset coming into the hold of A on 6/6. So 6/6/24 to 4/8/24 the asset is with A. So if you consider that 5 days, from 6 onwards, 6/6 to 36, that means 25 days it was with A in June. And July 31 days, August up to 4/8 means 4 days only with A. That means total 60 days. And with B from 5/8 to 31/3. That means the same 231 days it is with them. The total we are getting actually 299 days. So we can apportion between these two. It is actually 6 to 4/8 60 days, and 5/8 to 231 days. So the total depreciation is under 15% is 9,000. So 9,000 we will apportion between these two. Then we will get 1,806 for A and 7,194 for B. Total 9,000 rupees. Now let us consider another case. One more asset was purchased on 11/10/24. 11/10/24 means already it is amalgamated in August. Now it is actually October also after actually 3rd October. Okay, 3rd October means actually less than 170 days only. So it will get 50% only. Only depreciation we can give only 50%. So Z was purchased, but when it is purchased, it is fully with B. So A will not get any portion of the depreciation. Only B will get. So depreciation is of the 80,000, 15% depreciation at 50%. Since it is used for less than 180 days, so 6,000 will be available to B. Okay, who is the successor? Okay. Let us consider another example. Sai Limited has a block of assets carrying 15% rate of depreciation, whose WDB on 1/4/24 was 40 lakhs. So Sai Limited was having some assets. The block of assets actually that depreciation is 15%. So from 1/4/24, okay, WDB on 1/4/24 is 40 lakhs. Purchased another asset on 1/11/24 for 14.4 lakhs. So and put to use same day. Sai Limited was amalgamated with the Shruti Limited from 1/1/25. So the date of amalgamation is 1/1/25, and at the time of amalgamation there are two assets with the Sai. One asset having WDB 40 lakhs, okay, and that asset was with the Sai from 1/4/24 to 31/12/24, because 1/1/25 it is amalgamated. From 1/1/24 onwards it is with the amalgamated company. 1/1/25 to 31/3. That means up to 31/12/24 it was with the Sai Limited. So the asset is with the Sai Limited from 1/4/24 to 31/12/24. That is 275 days. You can calculate it here. April 30 days. Like then, if you are calculating the total up to December 31st is 275 days. And with the Shruti Limited from January 1/1/25 onward. That means January 31st, February 28, and March 31st. The total 90 days. 90 days it was with the Shruti, and 275 days it was with the Sai. And the second asset was purchased on 1/11/24. Okay, so for increase the second asset 1/11/24 to 31/12/24 for 2 months. It was with the Sai Limited. Okay, 1/11/24 mean 11 in November it is 30 days, and December it is 31 days. Total 61 days it was with the Sai, and the balance it is with the Shruti only. That is the same 90 days only, because after amalgamation it is with the Shruti. Okay, so as far as Shruti is concerned, it is actually the 90 days, both assets with them for 90 days. But Sai is concerned actually the first asset for 275 days, second asset is from 461 days only. So you can calculate it here. So the block of assets, the two block of assets were there. Open WDB 40. See in the block, for the block of asset, open WDB is 40 lakhs, okay, given. Then the one asset was purchased in 1/11/24. That will be 1/11 mean less than 180 days only, because after 3rd October it is less than 180 days. That is 40 lakhs 40,000. So when you calculate the depreciation, first we will calculate the depreciation. Depreciation we have to calculate. So we are calculating depreciation. Both the depreciation we are calculating first asset for 15 days. Okay, we will calculate for 15% we will calculate, and second asset we will calculate for 50% we will calculate. Okay, then it will be 10800. Okay, 1,08,000. First case it is 6 lakhs. Total 7 lakhs 8,000. It is the same actually. If you are considering it first actually, okay, it will be the same. For this first 14 lakh 40,000 is less than 180 days. Then actually after the total 4,000 we will deduct the first assets. The asset for which the depreciation is less than 180 days. Then we will get 40 lakhs. For the 40 lakhs we will consider 15%. Then we will add together. We will get 7 lakhs 8,000. Okay. Then share of the Sai Limited is for the 40 lakh assets. Actually, we have calculated it was total 365 days. The full year it was 1/4 to 31/3. See, it was. We will consider as if there is no amalgamation. So for 365 days, 275 days it was the Sai. So 275 by 365 into 6 lakhs. So it will get the share of 4 lakhs 52,055. Okay. And for the second asset, actually, it is acquired on 1/11/24, and with the Sai for 2 months, 1/11/24 to 31/12, total 61 days. So the Sai Limited was 90, and 90 days it was with the Shruti. The total 61 plus 90, it is 151 days. Out of 151 days, 61 divided by 151 into 1,08,000. This is 1,08,000. So you will get the share. Share you will get 43,629. Now, as far as Shruti is concerned, it is for 90 days, both the cases. So, first case 6 lakhs depreciation was there. So, 90 divided by 365, it will get the share of 1,47,945. And for the second asset, 14.4 lakhs asset actually, only for 90 days it was with them. So, 90 by 151 into 1,08,000, it will get 64,371 rupees. Okay. Yeah, let us consider a question here. Siddhant and Company, a sole proprietary trading concern, is converted into Siddhant Company Limited with effect from 29/11/24. Means when at the date of conversion 29/11/24, it is actually less than 179 days as per the depreciation concern, because up to 3rd October only 180 days will be considered. After that it will be less than 180 days. Okay. Now the WDV with the asset as on 1/4/24. So for Siddhant and Company is a sole proprietorship. It is not a company registered on the Companies Act. Companies Act registered, actually it should be limited, should be there. Then Siddhant Company Limited is registered under Companies Act, but Siddhant Company is a proprietorship company. Okay. So just because it is written and company, it is not a company. It's just like in the name. That's all. Okay. So as on 1/4/24, the items were in the block WDV was actually building 10% at a 10% depreciation. WDV as on 1/4/24 is 3,50,000. Then for furniture, it is 10% depreciation. It is 50,000. Plant and machinery 15% depreciation, 2 lakhs. The total WDV at the beginning will be the total of all. Okay. Further, on October 15, 24, still it is Siddhant and Company. While it is Siddhant and Company, it purchased a plant for 1 lakh at the rate of 15%. Then after conversion to Siddhant Company Limited, then it purchased one more asset. That is on after 29/11. That means it is less than 180 days only applicable. Therefore, you will get only 50% of the depreciation for this asset. Compute depreciation available to Siddhant Company and Siddhant Company Limited for the assessment year 25-26. In case of conversion of sole proprietary concern into company as per section 47(14), the depreciation is calculated for the whole year. First we have to calculate the depreciation for the whole year as if no conversion taken place. Then we have to apportion between Siddhant Company and Siddhant Company Limited. Okay. So let us consider for the Siddhant and Company, for the assets, whatever asset is there, we will calculate actually at the time of conversion. So how many days the assets were there with Siddhant and Company and with Siddhant Limited Company. From 1/4 to 29/11. 29/11 it was converted. Therefore, up to 28/11 only we have to consider. Therefore, April 30 days, like that. If you are adding the months total, you will get 242 days. And from 29 onwards, it is 29 November onwards, it will mean the assets with Siddhant Limited. So for 29 and 32 days in November, and the balance days actually you will total together, you will get 123 days for Siddhant Limited. Okay. Then computation depreciation allowable to Siddhant Company. So we know that the WDV was there for 3,50,000 and the depreciation 10% is 35,000 is the depreciation. Furniture WDV 1/4/24, because it is actually we are calculating the depreciation as if there is no conversion. Okay, for the full year we are calculating the full depreciation we are calculating, because from 1/4/24 onwards it is with the Siddhant and Company. So the depreciation for the furniture is actually for 50,000 and the rate of 10% it is 5,000. For P&M it is 2 lakhs. Okay, 1/4/24 2 lakhs plus one purchase is there on 1510. Okay, purchase is for 1 lakh 15.